Hello, everyone. Thank you for joining us. Got folks coming into the webinar. I'll take a second here to get everybody kind of situated, go through a few housekeeping items. My name is Debbie Fossum. I work with Armanino's marketing team, and I'll be here to kind of support you along the way today, along with Dean Kuyambo, who we'll get to in just a second. He's far more interesting than I am. So let's get started. Hopefully you're here for, this 3-hour CPE event, a simplified deal, the playbook for your next transaction. These guys are very excited to kind of go through all this content with you. So we'll kind of go through a few reminders for CPE. You must actively respond to all polling questions and stay on for the duration of the broadcast. If you have any technical difficulties, email the Elevate Learn that is there. Send me a chat in the webinar chat function. If you've got questions or comments for the team, or again, myself, if you're having issues, please submit them via the chat. I'll be watching that throughout the conversation. Learning objectives and kind of what we're hoping to get out of this high level. Review the current state of the transaction market, be it IPO, SPAC, M&A, you name it, we'll go through it all. Evaluate some recent case studies and best practices that this team has been through, they've lived through, either as a former CFO, former controller, helping our clients, all the things. We know it, we've been there, we're going to tell you about it. And then determine what a playbook for your next transaction could look like, again, depending on what it is. Some various CPE notes over here on the side. Again, this is national CPE, 3 credits of tax. And our agenda. So again, a lot to cover. So I've got a lot of time here. We'll start with some introductions in just a second. We'll look at the state of the transaction market, look at some strategies and KPIs for optimizing value with Jeff, talk about the IPO and SPAC transaction market with David Greenemeyer, Tom Brunton, Todd Bishop, and then talk through a seller's exit strategy with Brian, and then bring everybody kind of back together again for those takeaways in that playbook for your next transaction. So with that, Dean, hopefully I've given you a little bit of a break here before we jump in. Actually, no, I lied to you. I'm going to give you more. It's a polling question. So speaking of that CPE polling question, let's make sure we get our first one in. I wanted to start it off super easy. What day is today? Okay, I know it just daylight savings time just happened. I don't know what day it is, but let's get that in there. Let's answer that pretty quickly. We've always got somebody who's smart, who somebody answered Wednesday. So,
all that matters is that this is your first question, and for you to get your CPE, this is just click the button and let's get the credit. We all know year end is approaching very fast, and we want to get that CPE in.
That's right. And I will say, while people are answering this, I know that there were some hiccups. As a part of this, we sent everybody a DoorDash lunch gift card. There were some hiccups. We figured it out. If you still haven't gotten it, it's on the way, so I apologize. But if you still need it, you don't have it by the end of the day, please email me, let me know. We will take care of you. So,
great.
All right.
And we have one person say they didn't hear the question. So the question is, what day is it today?
Well, and they should see the question. So hopefully
Right.
It's showing up as a pop-up window on your screen. And then you should be able
your
to actually
cue.
click through it.
Go find that screen.
Yep. If not, Amy, just put a response in the chat to me. Beautiful. There you go. So, good stuff. All right, let's get this party started. I'm going to end this poll. Call it a day. We'll share this. It'll be fun. There you go. Most people know what's going on. We got 3 people who think it's Monday or Wednesday. Cool. All right. And with that, Dean, turn it over to you.
All right. Well, with that said, I think that the transaction title today, or the webinar title of a simplified deal, is the real driver, Deb, of why so many people are signed up today. I think it's great. Oh, there we go. Somebody needs their gift card. Yeah, please reply. You're going to see that email from Debbie Fossum. Please reply to that. We'll get you that gift card. I think it's all, there's a very popular song from a couple years ago. It's called Going Up on a Tuesday, to go back to our very first polling question. That is going to happen. Yeah, absolutely. We love it. Hello from San Francisco. Why don't we get everybody there? While we're doing our intros, why doesn't everybody tell us where you are dialing in from? I love it. Gary, Indiana. I am personally in Austin, Texas, our new Armanino offices in Austin. Happy to be here. With that said, let me start by introducing all of our experts today. Love seeing all the different places all around the country. People are dialing in. This is great. Jeff, why don't you do an intro?
Sure. Jeff Zilmer. I'm a CFO consultant here with Armanino. Prior to Armanino, I spent 20 years as a sitting CFO in companies. So I spent 30 plus years in technology, I've been a public company CFO, global multi-billion-dollar publicly traded company. And then the last 10 years or so, I did venture capital and private equity-backed software companies, usually sub $100 million. And covered a wide variety of industries here at Armanino, from cannabis to waste management to SaaS to beverage companies. So it's been an exciting ride for me.
Awesome. We're happy to have you here, Jeff. Looking forward to all the insight you're going to provide. David, you're up.
Yeah, I'm David Greenemeyer. I'm a tax partner based out of San Jose, California, heavily focused in the corporate tax space, GAAP, ASC 740, income tax accounting, and I help lead the SEC practice on the tax side of things. So looking forward to this webcast and talking through how to get ready for a transaction from a tax perspective.
That's great. Tom, you're up.
Hey everyone, Tom Brunton, Managing Director out of Dallas. I think poor David, and he's probably tired of hearing my voice with the number of calls we've been on lately, but I guess I have the benefit of going after him. I'm the technical accounting, financial reporting, and general kind of accounting support as it relates to these transactions. So I get to be on your team a little bit as you bully the auditors that are sitting across the table from you and have some fun kind of crafting the justification for certain positions and supporting you throughout the transaction. Good to be here.
Awesome. Todd, you're up.
Afternoon, everybody. Thanks for joining us today. Todd Bishop. I'm a partner in Armanino's risk assurance and advisory practice. I lead our SOX 404 and internal audit client portfolio for the firm. My background is a combination of public and industry. So I started my career at PwC and spent 12 years there in the risk assurance practice. Then I went into industry and led global internal audit and global SOX for 2 public companies in the Bay Area for almost 8 years. Been with Armanino now for 3.5. I've served clients across multiple industries. I'm based in our San Francisco office, though I live in the Pacific Northwest, so spend a lot of time up in our Seattle office as well. We serve clients nationally and help not only mature public companies, but pre-public and newly public companies get ready for their SEC compliance.
Well, Todd, you're a popular person these days. I know that much for sure. Brian, you're up.
Thanks, Dean. I'm Brian Griff. I'm the partner in charge of the transaction advisory services and private equity industry for Armanino. I work out of the St. Louis office, but this week I'm actually calling in from Las Vegas, Nevada, where I'm attending one of the AICPA valuation conferences. Started my career at Arthur Andersen. I left to actually be a corporate controller to go through an IPO back in 1998. Worked in industry for 17 years in various C-suite roles. My last job was as CEO of a private equity-owned company that did 10 acquisitions and then took it through a sale process. In the last 8 years of running the transaction practice, I've probably been involved in about 25 to 30 sale transactions a year. And that's going to be the part that I talk about for after all the IPO SPAC issues, about just if you just are interested in the things to do to sell your business. A lot of the topics will be very similar, and a lot of the things you need to do are similar, but a little bit different animal.
Thank you, Brian. Make sure you stay away from those tables in Vegas. I know there's a lot of accountants in Vegas right now for that AICPA conference. Definitely. All right, well, let's get to it. I think that is going to be a unique thing that we're going to talk about today. It's the access to capital both through public markets and private markets, right? And I think that that's going to be interesting to hear the different perspectives today. We all know right now that it seems like every day we turn on CNBC or whatever stock channel you're watching, it seems like the stock market is just every day is new highs. There are definitely lots of crazy factors, VUCA effects out in the world today, but it doesn't seem to be stopping or slowing the stock market. It is definitely up. It's been up for a while. And right now, don't see an end to that. If you were to take a look at the M&A activity in North America today, and go ahead, Deb, click the next slide. Yeah, you'll see that. And the interesting thing here is that according to PitchBook here, the deal count actually is, you know, on its way down. Valuations are definitely up, but the estimated deal count is rising. So that's what it's saying today. We'll dive deeper into this in Brian's section towards the end of our presentation, but definitely something to be interested in right there. Okay.
Yeah, Dean, if I could just add to that, I go to a number of M&A conferences, meet with tons of investment bankers and private equity firms. And, you know, you're seeing the COVID effect in 2020 and then a soaring rebound of deals. And then with some of the tax implications, a lot of owners are trying to rush to the finish line to sell their businesses. So a lot of people have described the M&A activity in North America as like 3 years compressed into one.
Great. Another reason that, you know, everything is tight right now. Resources are tight. Timing is tight. We're trying to get a lot done in a short window. Is that fair to say, Brian? Yeah, there you go. Okay. With that said, I think that'll set the tone for everything that we're going to talk about today. Okay, everyone. I know you're probably listening to this as you're doing some work. Polling question number 2. And this is your prediction of when will this bull market stall? Go ahead, Deb.
Yep, you should see it pop up on your screen, hopefully.
Ding, you should ring a bell or something. People's attention.
That's right. Get your CPE. You're going to get a lot of CPE today. Oh, I love it. I'm in Austin too, Janine. That's great. 3 months, 6 months, 9 months, or never. I'll tell you, I don't know. What's your glass ball say? This bull run has been running for a while. How many people have voted, Deb?
Get those in. We're at 60%. I'd like to see it a little bit higher.
Yeah, absolutely. We want to give everybody a chance to get your CPE.
Yep. Get those answers in. I'll close the poll in 3, 2, and 1. All right.
Uh-oh, 9 months. Here we go. 2022. If we had a crystal ball, everybody's wondering what's going to happen. Okay. Well, we'll see. Well, we shall see, right? I think everybody's been predicting the end of this bull run for a minute. All right, Jeff, you are up to talk about some strategies and KPIs for optimizing value. Go ahead and take it away, my friend.
Great, thanks, Dean. So you can flip to the next slide, Deb. So we're going to talk a little bit about, there we go, a number of factors. One, talk about upfront, what you can and should be doing really starting today. Every business is different. Every kind of situation is different. But there's some common steps that if you take them now, you start timely, you can make the whole process go much smoother and ensure there's no hiccups along the way or delays along the way, or worse, something pops up in the middle of your process that gives the buyer or investor a chance to have you take a haircut on the price or value in any way. Also talk a little bit about some valuation metrics at a high level, and then internal metrics of what investors look at, what we should try to optimize for the firm. You can't make every metric perfect, but try to optimize and show positive trends. It'll just help the process and help your valuation to achieve the best outcome. First and foremost, you may hear this a few times today, getting the accounting in shape is really important. And it's not just bookkeeping. It's not just AP, AR kind of stuff. It's having your accounting, have it be GAAP based, not cash based. Go ahead and take the step to make that transition sooner rather than later. Accounts reconciled, books in shape, good revenue recognition, clean cap table, all the accounting that is going to be really important for a buyer coming in. And when they come in and really dive into the due diligence, you want it to be as clean as possible. And invariably there's always a little bit more work than you think that's gonna be there is kind of our experience, I think, collectively. So getting started on it sooner is absolutely best.
Jeff,
Beyond-
it's kind of like the remodel at your house, right? Oh, this is a very simple project. I don't need any new walls. I don't need it's very simple. And it always turns into a little bit more than you thought, right?
Yeah, and this is the plumbing. This is the nasty stuff sometimes. So you gotta just fight, clamp down and get it done. If that's a little tool time kind of phrase. Applying finance. So beyond just accounting, there's finance, doing financial analysis, having a good, robust, forward-looking forecast tool. You don't have to go out 5 years necessarily, but certainly an 18-month pretty good forecast model. 18 months to 3 years would be probably best practices, but some detail to it, so revenue isn't just one line item, hockey sticking up and to the right. You've got some robust drivers driving the model that you can play with and know that what are the things, the lead generation, the search engine optimization, the hiring of sales reps, the marketing campaign, new product introductions, all the things that are going to drive growth and value for the company, and laying them out in a detailed model, and then all the cost structure underneath it. It needs to be optimistic, and it needs to be realistic. You don't want it to be too aspirational as you go forward, because that can come back to bite you. Sometimes transactions, whether it's a buyout or it could have an earnout situation on the back end. And so, if you have a really aggressive model and forecast in place, they may, the buyer may say, okay, that's what we're going to use for you to earn out the back half of your purchase price on the deal, and you want to make sure it's something that's achievable. The business can hit those goals or come close, and get you the full value for the enterprise that you should be able to achieve. Understanding metrics. Every business has its key metrics, being able to understand them, and really getting down to what's the core economics of the business, both understanding it internally for yourselves, and then being able to convey that to potential buyers in a compelling way. And then the sales and partial process, buyout process itself. There's lots of paths that you can be taken. A lot of the prep steps are the same. Next slide. So there's a few things I'll do briefly on this, because I think the internal metrics will be a more interesting aspect of it. But there's different ways of looking at what is your business worth to potential buyers. There's looking at it from a competitive standpoint, looking at it just from your own internal value drivers, looking at the growth, and certainly growth is a huge contributor to getting the optimal value out of your business, and then opportunities you have starting it every day to improve the valuation of the company through improved operating performance or enhanced market penetration. Next one. So we'll look at a couple of different ways here. So from a competitive value benchmarks, and this is some work we've done for other clients, groups of cohorts of companies with a similar profile. How do you stack up against your competition? Are you a market leader? Are you someone who's up and comer in the market, who's found a new niche or can drive a new segment of the market, or are you just dominant market player? And depending on where you fit in this metric, this is measuring it against both size, relative to the available market, as well as the profitability that you're generating, and how do you compare with your competitors. And you can see what valuations that they're deriving, and try to optimize yourself. If you can be growing faster, it's obviously a much stronger story. If the rising tide lifts all boats kind of story, you don't have as compelling a value proposition to people. And then the profitability. Can you be more profitable than other people? Or if you're not more profitable, are you making investments for over the top growth that's exceeding the competition?
Jeff, obviously we can all track our internal metrics, right? We got a lot of folks on the line that know their revenue growth and their EBITDA growth, right? They can trend all of that. what might be harder is how they stack up against their peers. What do you suggest with where they could get that information? Obviously, they could look at the public data, but what if they're private? Any insight we can provide there?
That can be a tough one. So joining industry groups and doing, there are surveys that are done on a blind basis. They'll ask you to participate in a survey, and in exchange for keeping your data anonymous, they will share with you the results of those surveys, and they can be very valuable information. Tapping into investment bankers or firms like ourselves, where we may have some information that's available to people based on our experiences with other companies. So there's ways you have to. It's harder to seek out than obviously that if it's a public company, but you can getting some intelligence from the market can certainly be done. And the nice thing about investment bankers is you can engage investment bankers sometimes in advance of having a deal with them, because they will share information and try to help you in the hope that down the road, they're going to get your business. And
yeah,
so
that's good insight. That's good insight, Jeff, for sure.
Next chart. And then entity value drivers, which really will come down to more. How do you compare? What is your specific profile, the financial profile primarily, and we'll talk about other key metrics in a little bit. But it's ultimately, are you growing your revenue, your top line? Are you, do you have a strong value proposition with your offerings? You have very healthy gross margins, ideally exceeding your competition. Can you drive the right EBITDA either today or if you're investing for growth, you certainly have a path to profitability going forward that you can compellingly tell to the market. And then customer acquisition cost is another key metric. How much does it cost you to acquire each customer? And then there's some associated customer metrics, which we'll talk about in a second, that dovetail off of that. Next slide. There we go. So multiple driven valuations actually is probably the most common one everyone's heard. It's the language of the investment bankers and of the market. What multiple of revenue did you get for your company? What multiple of earnings did you get for your company? So it's a common language of the business. I personally believe that behind all of that, ultimately some financial person is doing a discounted cash flow analysis, because ultimately that's the way finance people look at an asset and how you value it. You look at how much you're going to pay today. What are the future cash flows that's going to be generated from this thing? What's my cost of capital? Does it fit within a window of value that is compelling? And then you're just negotiating the price that fits within that window. But it's, it'll be a little less visible to you. In each case, in our example here with this cohort of customers, of clients we were working with, there was a few different possibilities of looking at how the market worked. Product categorization was key for this example. It was driving the highest benchmark multiple, so 5 times EBITDA and about 2 times, a little less than 3 times revenue. Those metrics will vary depending on the profile of company and what category you fit into and who your competition is. But ultimately, if you're looking at a normal company, 5 to 10 times revenue is probably pretty typical, and then EBITDA similar. I'm sorry. So 3 to 5 times revenue and 5 to 10 times EBITDA. If you are truly a unicorn, that all these metrics can go out through the window. If you're really high growth and breaking through to a new market that has unlimited potential, and you see the 15 or 20 times revenue kind of metrics, that's great. At the end of the day, you got to look at yourself in the mirror and realize, not everybody's a unicorn. And so being realistic as you go in is always a little bit of a challenge. I had the opportunity to work with numerous very talented entrepreneurs who were often very starry-eyed about their future prospects. And so getting realistic, but continue to be optimistic and push for the highest value you can. But ultimately, if the goal is to get a deal done, you got to really understand the market and how your company fits within that profile. Next one. And then, really realistically assessing your own firm and say, okay, here's what we are worth today, and going in deep dive of how can we improve our valuation, prior to going out. And again, starting any of these activities early, if you give yourself, a year or two or three in order to be prepared and really focus on optimizing the value of the company, you can look at how do you improve gross margin? Can you offer a premium product? Can you, cull the product line to really focus on where you add value and make a difference? It can command a premium price. Can you, if you're manufacturing, how can you get the most out of your factories and be the most efficient in reducing costs? So again, expanding gross margin is always a really value driver that can be quite powerful, and you get a lot of leverage out of. Increasing, managing all this spending on freight and logistics. This is just examples, but across the board, optimizing all your expenses, any of your costs, your G&A infrastructure, trying to keep as much possible of variable costs and avoiding fixed costs where it makes sense so that you can respond quickly to changes in the market and changes in the business performance. It can really, and then investing. Where do you invest for sales growth? What's your market drivers, whether it's on the marketing side or feet on the street sales guys? Anything that you can invest in to increase the valuation before and as you head towards an exit transaction.
So Jeff, let's pause real quick. A couple
Sure.
questions have come through, but there's a lot of different categories here that could increase the value add or the overall valuation. Like, where do we start, right? Like, how do we make this as actionable as possible? Where's a good place to start? Do we start on data? Do we start on investments and tracking the return on investments? Like, what as a seasoned CFO, where do you start here?
Having good data, having a good data warehouse, having good information about your customers, about what they're buying, how often they're buying, whether it's a Salesforce tool or any other tool, having good metrics around your business and your customer is really a good place to start, I think, because ultimately that's what's going to drive the business and determine in large part its success. I think being organized optimally so that you have the most efficient fulfillment cycle for whatever your product line is really important. Understanding your profitability by product line and your unit economics. Again, it gets back to understanding the core economics of your business is really a key thing. And hiring the best and brightest and all that obviously is vitally important. You do want to make investments in your infrastructure, and don't if you're growing rapidly, trying to run the company off of Excel is not, ultimately it's going to break. You're going to lose track of something, and it's just too loosey goosey. So getting it where you're getting data, getting it into a data warehouse that's visible to broadly within the company, and you're all working off the same data sets and the same information about the customer and the market and the product lines can be really, really valuable, and it saves so much time. I've been in meetings where my number is X and my number is Y, and they're supposed to be the same number, and it's just it's frustrating for everybody.
Yeah, no, Jeff, here's another good question is, let's talk a little bit about the relationship between good accounting data and then the forecasting piece, right? Earlier you said that, kind of it comes back to a discounted cash flow model. And then you listed off some different metrics that would ultimately help judge what that would come up to. Maybe we can talk a little bit about just the relationship between good accounting data and how that goes into the forecasting model so that it could stand up and you have assumptions that you can be validated. Maybe you can talk about that a little bit.
Yeah, the mantra we kind of use is know yourself. And the way you know yourself and know your history is from good accurate accounting records. And historical accounting is always the basis for going forward as you build a forecast, because there's truth in history. There's truth in history. There's truth in trends of where your business is going that you have to own up to. And so knowing that if you're trending in one direction and you want to reverse that it's going to take action. It's going to take decisions. It's going to be, sometimes those are going to be hard decisions. But the accounting aspect of it, you just got to know where you are reality wise in the business from, again, getting back to your unit economics. Where are you making money? Where are you losing money? Where's the growth potential? And you discern all of that from your actuals. And it's beyond just the general ledger. It's when you get into the details of your customer profile, the bookings and backlog, where you're selling by region or by geography. There's a tons of information and data that you want to be capturing accurately. And then that's what you use to build your forecast going forward. And we'll talk a little bit more about that in the coming slides about metrics that we recommend people really keep an eye on and try to optimize.
Great. There's been as we all know, everybody's extremely busy, Jeff. And so people want to know, where can we get some of this comparison data without going to the SEC website and digging through public company financials? I know you said it earlier, but let's give everyone on the line a couple different avenues for finding this information. So you said investment bankers earlier. Who else could people use as a resource?
Your consultants, people like us, your audit firm may have some information. Any banker, doing searches on Google, you can still find a fair amount of information. And then again, participating in surveys and information requests that you get from various market research firms, where get the reputable ones, but people who you participate in a survey and you get anonymized results back, or even initiate that. You can initiate that, and it'll cost you a little money, but it'll give you some insights. But it can be tough, and it's surveying a lot of different people. We've got people within our firm who've worked in lots of different companies. So, when I was asked, what's the right business model, meaning how much should I invest in R&D? How much should I invest in G&A? How much should I invest in sales versus marketing? I've got my experience from various industries and different customers, different clients that I've worked with, that you have a sense for it, that given your revenue level, given your technology and your product line, and what level of gross margin you're going to drive, how much can you invest in each of those functions and drive a desired EBITDA or operating income percentage. So you got to dig and you got to, but it's, there's a reason they're called private companies. They tend to keep their information pretty private.
Great. Okay, that's helpful. I think now we go to our polling question number 3. So yes, Brian, if I had a bell, I would be ringing it right now. Ding, ding, ding. Everybody run back to your computer. Deb, why don't you help us out with our polling question number 3?
Yeah. Again, these aren't meant to be hard. To your point, Dean, right? We're just trying to get some CP. So are you considering any types of transactions? IPO, SPAC, M&A, unsure? I was going to be a little fun and just say, hey, I'm just here for the CPE, but I wanted to keep it a little bit more professional. So we've got these few answers here. To Dean's point, make sure you get those in. If for some reason I'm getting a lot of questions about, I missed a polling question. Hopefully, again, you see this is poll 3. Hopefully you see it pop up on your screen. Hopefully you can click on a button to answer. If you can't, for some reason, I've now sent I've sent my email through the chat. So email me and we will take care of it following the webinar.
Great. How many the polling question isn't showing. So maybe we just need to get that box. Go ahead and see if you see a pop-up box, Justin. I know that's what I see on my screen in front of the polling question number 3. All right. How many people have voted so far, Deb? Or what's the percentage?
62%. So
62. So we got to give everybody
more.
another, let's get this up to 90, everyone. We don't want you to miss your CPE. It's very easy. All you have to do is click the button.
I feel like Jeff's at a racetrack right now. I kind of feel like where he is.
Jealous. All right. What's our percentage now, Deb?
We're at 62. I feel like actually, not everybody is here just for the CPE.
Okay.
Could be in good
All right.
shape. So, All right, I'm going to end the poll here. Again, email me if you're having any issues. And thank you, Brian, for the correction on the question. Just a simple marketing person over here, so I appreciate that. I will end the poll and share the results really quickly.
Wow. Look at that.
Yeah.
That'll be great for all of our panelists today, that half of the people here could be looking at a potential M&A.
Yeah.
So I think that'll be very helpful. And thank you for responding, because I think that'll help us tailor some of the insight that we want to provide today. But again, let's keep on making this as interactive as possible. We're here to answer your questions, so keep on filling that in the chat. All right, Jeff.
Cool. So I think there was one question in the chat that I glanced at about, is this really just all formula driven? And, is there not value in, intellectual property and brand and all the a bunch of other, perhaps more subjective factors. So it's not just formula driven. Obviously, the potential of the business is what's going to attract potential buyers and potential business standalone and or potential for a business of how it fits within an existing business. If you're, it's going to be an M&A transaction where you're being bought and integrated into a larger firm. Intellectual property can be tremendously valuable. It helps if it's generating cash flow, just to be honest with you. If there's a potential royalty stream or there's applications outside of the current field of use that it's being applied, that you can either sell or license, create recurring revenue streams off of with minimal costs. So intellectual property in and of itself, maybe not. It may be valuable to a strategic buyer and how it fits in with their future growth plans. That would still come down to, someone's going to generate cash flow off of it. But there are certainly less or more subjective factors that companies take into account all the time, including a brand. If you have a strong brand, that's, even if it's a legacy strong brand and maybe the company isn't performing, that still could be attracted to an up and coming company who, could buy a company that's maybe even bigger than them, and then take on their name. And there's been several examples of that historically, just to get instant recognition in the marketplace. And so it's there's multiple paths forward from that. So it is beyond just the formula driven thing. So the next kind of key couple of things I was going to talk about is kind of key metrics that you can start focusing on today and having a story. And so revenue growth is always going to be, a top one. It really is best if you have growth in the trailing 12 months and in the rearview mirror, and not just, flat, and then a hockey stick going forward in the future. It just adds credibility to your story and will attract people's attention. And, it'll shorten the conversation of, can you keep growing versus how do you turn this thing around from being flat or declining into a growth story. It's hard to pitch a V-shaped turnaround if revenue is going one direction, and so you want to stabilize the revenue streams as much as possible and be able to show some growth. Being able to communicate a strong sales pipeline that's well defined, understanding who's in the pipeline, where the deals are, what the value of them is, what's the probability of closure, looking at a weighted average pipeline value for the short term and for the intermediate term. Longer term, obviously it's harder. Focusing on the customer concentration. If you have a very diverse customer set, it's actually it's obviously more compelling. I apologize if there's some noise in my background here. Recurring revenue is extremely attractive to people. There's a stickiness to it. You see with software companies and service companies that have, sticky recurring revenue with auto renewals. It can be very appealing to people. Long-term customer relationships, obviously, demonstrate the value that you bring to the customer and how you lock them in, build in customer loyalty. And then along with that is, having a good balance of being able to upsell existing customers, either additional applications or additional products or additional users of the product. And then balancing that with acquiring new customers. So So a balance of that can be very attractive to potential buyers. And then efficient customer acquisition, right? So it's, if it costs you $1,000 to get a customer that's going to deliver $100,000 of revenue over the next 3 years, that's a very compelling story. And so knowing your best path to market and your best path for getting customers quickly. Dean?
Jeff, real quick before we jump off of this slide, and I think Brian might have a comment as well. But
Sure.
when you look at this, are all of these just readily known by most, company leadership? Do they know all of these, or are there going to be some companies that are like, oh man, we don't really track that?
I think the discipline around the sales pipeline can be one, because you want to be honest with yourselves, because it's easy to say all your deals have high probability of success and they're all going to close next quarter or within 6 months. There's got to be a lot of honesty and checks and balances within, so you're not drinking your own Kool-Aid. Most of this stuff should be visible to you as a customer. This is mostly internal activities, and so what they are, you can measure them, and keeping them at the forefront. What you measure gets better, and so keeping it in the forefront and pushing and putting actions in place to improve them can go a long way towards optimizing your value.
Yeah, Jeff, I was just going to chime in as you went through each of these points. I actually have a client who is expecting to sign a sale agreement on Thursday this week. And we started working with them 5 years ago. And they were $100 million business that had not grown for 3 years. And they had about a $35 million customer. They had a sizable customer concentration issue. And we talked to them about all these growth things that needed to be done if they really wanted to maximize the value. And they started off by reaching out to our group to do a valuation on the business, say, well, where do you think it might sell for? And at the time, I think we came in somewhere around 85 to 90 million. Their EBITDA was strong, as a good business, well managed. They didn't quite have their leadership team all in place. And we worked with them over the 5 years, and now they're looking at potentially a $285 million sale price with a strong rollover equity piece. And of course, they grew the business and they did a lot of the things that we helped consult them on. It's been a great success story, and fingers are crossed it closes on Thursday.
That's awesome. It's a great story, a great real world example of the difference you can make by starting early and putting actions in place. Anything else, or next slide? So then, so after revenue comes down to profitability and cash flow. And so, I've talked about gross margins multiple times. It's really the unit economics of your business. You could be losing money if you're investing for growth, investing sales and marketing dollars to get, the next quarter, next year's revenue, if your unit economics make sense. So that if you hit a wall or something goes sideways in the market, if you stopped investing for growth for a while, your business would turn profitable because you have positive and strong unit economics of, each incremental revenue dollar that you generate is actually contributing straight through to the bottom line. And that goes hand in hand with operating leverage and the concept of value creation. Are you creating value in your product line and in your supply chain with each incremental dollar that you're selling through? And so being able to convey that to a potential buyer gives them the confidence that additional investment in R&D or additional investment in sales and marketing has a chance to expand the business even further, but that the core economics of the business are sound, solid, and can sustain itself, in good times or bad. And bad times do happen sometimes, and so we just have to acknowledge that and be prepared for it. Efficient operating expenses. I do make the point that you got to make critical investments in infrastructure, in governance, in business intelligence. You don't want to cut costs or have the lowest G&A in the industry necessarily. It doesn't mean you're the most efficient or the most effective. And so spending every dollar in the most effective way is more important. And having good governance, it will be increasingly important as you can see investments people are making or commitments people are making to ESG, invest in those areas and stay current, and it'll be increasingly valuable to future buyers and future investors. EBITDA, it's always for us, either positive today or a clear path to profitability. Free cash flow positive obviously is always a very strong thing. We focus on effect on working capital as well. A lot of times, people are not focused so much on the balance sheet. You focus on the income statement, but how you manage your AR, how you manage your inventory, how you manage your accounts payable and your cash conversion cycle is all critically important. And you can lose a lot of cash flow in working capital if it's not carefully managed and pay as much attention to that as you do to the income statement and growing top line revenue. Questions? Next slide. I think it's my last one. So some other factors just to consider, which I've run across in my time. So people, investment bankers, particularly or new buyers, love to talk about historical forecast accuracy. As you're showing me a forecast that shows you're going to quadruple the business the next 2 years, how have you done in the past? And you don't want that to be a gotcha, because they'll just use it to ping you on the valuation a little bit, or kind of crunch you down and put you on the defensive in the conversations, and just not a good place to be at all. So
Joe, I got to ask you, so what's the number that we want to have here with regards to our accuracy? What's our percentage level of confidence here?
I think if you're 80%, you're probably top one of the top quartile or higher of performers, because I think forecast accuracy is a challenge for a lot of companies, especially when they're going into a process like this, because you want to put your best foot forward. You want to be optimistic. You want to be aspirational. And so, 90% plus, 95% plus would be ideal. You don't see it that much. So being there would definitely put you ahead of many other pitches that investors typically hear. If you're talking to private equity guys or potential, going public, either IPO or participating in a SPAC, those investors that are used to seeing 20, 30 pitches a week, and everything, looks upwards and to the right on every single pitch. And so they're going to have a level of skepticism, professional skepticism, but skepticism nonetheless. So being able to say, hey, here's my forecast and here's what I've done in the past, can be a pretty compelling story to help you. Competitive positioning and being honest in a strength and weakness and opportunity and threat analysis. As much as possible, being able to articulate the total available market for what you're offering either today or what's in your R&D pipeline, so that you want a big, compelling market that you can dominate a segment of. And so that's compelling to people to go for market leaders or people who have the potential to be market leaders. There's always a temptation to veer away from GAAP financials and do pro formas. That's fine, but you do want to keep it simple, because you can confuse people, and people get confused, get frustrated, and may lose interest. It's making some adjustments, and I think the team will talk later about that with a quality of earnings kind of analysis. But doing pro forma is okay, but just don't go crazy with it. And then, and part of that is excluding one-time historical events and any kind of deals that just aren't going to repeat. And you can exclude those to show a positive trend in your business. Or if you have a new business that's breaking out from a legacy business and the new business is growing fast, isolating and highlighting that is certainly always a very compelling, because people can see how you're converting and transforming the company to a new product line, new product direction, new market direction. And finally, just normalizing LLC spending. If we've worked with plenty of LLCs. Sometimes you run to some family members through the payroll or some personal expenses through the business. It's all legit, no problem on an LLC. But as you're looking at a potential public company or selling to a corporate buyer, you want to try to normalize that as much as possible, so they can see what it's going to look like when you're through to the other side of the transaction. Questions?
Awesome. Yeah, do we have any questions so far? We're going to jump into this polling question, and here's what we're going to do since the top of the hour is coming. We are going to, everybody, make sure you answer this polling question. We're at polling question number 4. We're also going to ask you to put any questions that you might have so far, and we'll give everybody about a 5-minute bio break. And then when we come back, we will answer the questions that have been submitted and then move on to the next section, which is IPOs and SPACs. Okay, but with regards to that, yep, we'll jump back in at 1:55 for Q&A. So with that said, which key metrics matter most? Go ahead, Deb.
Yep, I'm sorry, I meant 1:55 Mountain Time. I know everybody's on different time zones, so wherever you are, equivalent of 12:55 Pacific, 1:55 Mountain, all the good stuff. Give us 5 minutes. But poll number 4: which key metrics matter most? Revenue, profitability, and cash flow, other factors, all of the above. Make sure you get those in. We're at about 62%, 63%. That seems to be our sweet spot today. Get those in there. I'll close this poll in 3, 2, and 1. I'll leave that up there, but then we can actually come back for some questions here before jumping into the other one. So see you in a few minutes.
Yep, let's do that. Everybody, please get your question in. Go ahead and get some water, stretch, take a bio break. We'll be back in 5 minutes. All right, everyone. Well, we are about a third of a way through this 3-hour long CPE event. We've seen some good questions come through on the chat, and definitely want to pull everybody back. And this goes to all of our panelists. Please feel free to answer. So as everybody just comes back here in the next minute or two, we'll go ahead and answer some of these questions. And if you have any other questions you want to put in, let us know before we move on to IPOs and SPACs and public markets. Okay, so the very first question was, what is the best way to initially get in touch with a VC or PE? There are many platforms out there these days, but would you have an alternative suggestion for making introductions? And that's to any of our panelists. Anyone want to take that?
One great source, if you have a board of directors, if you're an organization of that substance and has that kind of governance structure in place, board of directors can be an amazing place to find contacts in the investment community. Oftentimes that would be typically a first go-to place from my perspective.
Great. And if any of you are Armanino clients, feel free to reach out to us as well. We'll feel free to bring the power of our network to you as well and see what we can do to help here. Another one, and this I thought was really good, from Kay. Any thoughts on whether COVID affected results should be presented differently in historicals? Any thoughts on that? Especially if, hey, maybe you had great results during COVID, but you don't know if that's going to come back down, as we have heard in some businesses that things have kind of normalized a little bit. Any thoughts on that?
Yeah, basically what we're seeing in the transaction and valuation world is if you were a business that was not negatively impacted by COVID, your valuations have probably gone up, and clients, buyers are much more interested in a business that was able to be recession resistant or even improve during those times. As you saw from some of the multiple valuations, all businesses are being valued pretty high right now with all the money that's out there on the table trying to drive transactions. So if you've been able to demonstrate an upward growth trend and good recovery and good management through that process, you can still get back to those valuation levels and even beyond where you might have been before COVID.
Very helpful, Brian. That's good stuff. Thank you.
I think you also get a little bit of a benefit of the doubt if you were negatively impacted, because so many people were, that, if you have a legitimate story about, down performance during COVID, it is accepted, right? It's not, and if you have a compelling story for recovery, you do get a bit of the benefit of the doubt that you wouldn't in kind of similar circumstances without such a pandemic.
Awesome. Okay. And one more. When is it better to use an investment banker rather than go it alone? Give any insight on that.
Yeah, I'd say the answer depends. I mean, it does depend a lot on the circumstance, the potential buyer. We've helped a number of our clients when a potential buyer was approached by an acquirer they felt was a great fit, and they got offered a price that we were able to help justify the valuation and the after-tax cash proceeds on. And we were able to really help the buyer go through the seller go through the process without an investment banker. I tend to use a rule of thumb, though, when I'm talking to clients in that situation, that I tell them that there's always the possibility an investment banker who is well respected and runs a really good process to maximize the value and increase the value over a non-competitive process. So it really kind of depends on what you're looking for. The risks of a competitive auction process is your people, your client, your customers, they might find out. It can cause a lot of turmoil. You might not have the finance support staff to deal with all the due diligence requests that come in and deal with that process. A very small proprietary process with one buyer. We can help a client go through that process and take some of that burden off the finance group to help them go through and reach a successful conclusion and try to do it discreetly and confidentially to still be successful.
Yeah, the process can be pretty demanding on the entire executive team and finance team, as Brian mentioned. So having an extra pair of hands can be helpful. Letting the executive team focus on continuing to drive and manage the business, so you don't have a hiccup in performance in the middle of your process. They can be very helpful if it's the right size deal, and it's an extra pair of hands.
Awesome. Thank you, Jeff and Brian. Lots of insight in that very first session. Now we're going to transition everyone to IPO and SPAC transactions. The first slide that we'll kind of jump into is, what do SPAC and the SPACs, the market activity look like? And yeah, we at Armanino saw this and felt this. We saw our clients starting to do this in about Q3 of last year, and the spike into 2021 was tremendous, right? Tom, David, Todd, you're all here. You're still living and breathing. I'm happy that you guys made it to the other side. I know how busy you have been. What's your life been like over the last 10 to 12 months here as we've been going through SPAC mania?
Yeah, Tom, I'll jump in. The most common question I get, Dean, because I've actually been involved with SPACs since all the way back to 2017. And so looking at this graph, right, you see these numbers. And so I always get the question, are SPACs cooling off? Well, look at this graph. Yes. Is it cooling off as compared to Q3, Q4, Q1? It's cooling off, but I think we're going to see a more normalized SPAC line going forward. I think it's going to be a much more useful tool for companies to go public. You're not going to see these smaller numbers we saw back in 17, 18, and 19. You're going to see more normalized numbers going forward. So it's been a lot of fun. It's no longer kind of a taboo, I guess, way to go public. And yeah, Tom can speak to it as well.
I think, Dean, to your point, we're still here, 10 months, a year on from when it really started crushing. And as much as I hate to say it, we probably have the SEC to thank a little bit, right? There's no prizes for guessing where the SEC started coming out and slowing things down this year with that graph. It definitely spooked a lot of people. It definitely slowed a lot of things down from the sponsor side with the warrants guidance that came out. And so, yeah, I agree with David, right? It's going to be a normalized process. It is going to be a path to being public. It's not going to be this wonky fly-by-night kind of path that people started talking about in CNBC. It's become very mainstream, and it's been an interesting trend, right? It's been around long enough to see a little bit of a cycle, full cycle, go from this craze that everyone was trying to get into the liquidity crush to then you get the bifurcation between pipe and no pipe on the SPAC sponsor side, and we'd start seeing the differentiation there. And then now it's more of like we're seeing companies take a step back and say, is it traditional IPO? Is it SPAC? Is it strategic sale? How do we need to think about this to get the best value for the company and what we want to do on a go-forward basis? So I know, Todd, you've got a unique perspective from the internal controls standpoint, but want to give you the chance to kind of speak on it.
Yeah, certainly from my perspective, the last 18 months have been nothing like anything I've seen in my 22 plus year career. Lots of exciting opportunities to work with companies who need help, right? They have smaller teams. They don't always have public company experience on their org chart. And so they need help from everything from cleaning up the books, writing technical accounting memos, getting through the audit, all the way through controls readiness.
Awesome. And then if we go to our next slide, Deb, that's the volume. Now here's the average size of the SPAC deals, team, is this information consistent with what you're seeing in our client base and the folks that we're helping, the size of activity?
Yeah, I would say the deal size is obviously going up, and I've worked with a lot of SPACs themselves, the actual sponsor and SPAC itself, and they're raising more and more cash when the SPAC itself IPOs, and they're looking at much larger deal size. Even at the beginning of the SPAC craze, the deal size was much smaller than what we're seeing today. So when I talk to those CFOs and ask them, what kind of client are you looking for? They said, well, they got to be worth at least this for us to even talk to them. And that number has increased dramatically since even, early 2020.
Yeah, and I think we're going to see that on the next slide. If you go right into that and the acquisition activity, look at the exit value, right? Just like you said, David, exit values are up, and we're starting to see it creep up larger and larger. Is that fair?
Yeah, absolutely. People are in the market to buy big companies, and so we have smaller companies out there that are still seeing if this is a path. There's certainly SPACs out there where this is a path. We're seeing there's lots of money, right? The first graph was how well the stock market's doing. There's a lot of money out there, right? And so people want to spend that money on companies.
That's great. That's great. Okay. Our next slide is the pipe and what that looks like, I believe. Go ahead, Deb. Yep. And here you see that just the deals without pipes and associated pipe deals, and you see that is continuing to be strong as well. Everybody definitely is utilizing that method for sure. Any thoughts on this slide, or just what we expect to see?
I mean, directionally, right, it makes sense. As deal size gets bigger, you'd expect more pipe involved instead of it just being pure, excluding pipe. So, I mean, for me, this is more just proof of the direction that the market's going with SPACs and how it's going, say, upstream, right, on deal size, to where it all kind of blends together and paints the picture in a cohesive way.
Got a good question there. What is the benefit of pipe versus not?
So I'll take a stab at this, and David, you can probably laugh at me and correct.
Tom, even before you get into that, for those that may not even be aware, like, can somebody give me a really high level, like, what is a pipe? Because, it sounds fun, but, it sounds, I don't know. Can you kind of give me a 2-second overview of that and then jump into the benefit?
Yeah, so PIPE is public investment, private investment in public entity. And so it's effectively mutual funds, bankers getting in before the deal consummates to where they're investing and raising capital inside. And so where we were seeing the big difference effectively in the spring, I would say, was the PIPE market froze up a little bit. And so there was capital, I don't want to say capital constraints, but there was limitations, right, on how much SPACs sponsors themselves had to splash around as part of acquisitions. And so the SPAC sponsors that had PIPE locked up already basically had a direct line to be able to close their deals without having these extra roadblocks or hurdles to go through to raise more cash. David, feel free. I mean, you've been a little more on the SPAC sponsor side than me. I've been more on the target side, so you may have a different view.
I think an easy way to kind of define the PIPE, if you're familiar with IPOs, is, this is really the participation in the pre-IPO, right? And so to Tom's point, there really is no benefit of PIPE versus not. Sometimes you need the PIPE in order to get the valuation that you want to go public at. So, one of the, I guess, advantages of a SPAC is you dictate the valuation you're going public at. And so you've got to raise enough cash via however much cash is sitting with the SPAC in their trust account that they raised when they went IPO. And then you have to go out and market yourself and roadshow to raise the PIPE so that you can hit that valuation. And so I think, Tom, you really nailed it. This is really indicative of the deal size. I don't think you can really go SPAC anymore without a pipe. What I'd say where the benefit comes in is if you've already have the pipe kind of locked down. You've already went out and found some more investors, just like you would in any other M&A transaction, that, either verbally or formally subscribe to the pipe. So hopefully that helps define kind of the nuances of the SPAC in a pipe.
Yeah, thank you. That is a really good insight right there for sure. All right, the next slide is just the number of public listings. I mean, David, you just talked about this, and just stock market's up. There's money out there, and people are trying to access the money. I think it's fair to say we might have more public companies today than ever. And so, I think that there's going to be a lot of people who are looking for your insight listening here. So, okay. Okay. Is there last thing on that pipe is pipe also an indication of the original SPAC investors redeeming and needing to be replaced?
Yeah, there's always risk that, the original SPAC investors could, fully redeem, right? So again, kind of a little mini education on a SPAC. They go IPO and sell their shares for $10 to raise as much cash as they want to raise. Let's call it 300 million. Each person that invests in that SPAC, they can redeem. They can get their $10 back if they don't believe that the company they picked to merge or take public is a good company. So there's always risk of that, and the pipe is somewhat of a hedge to that.
Awesome. Okay. Everyone, we are at our polling question number 5. Go ahead, Debs.
Right now. Which path the public will take the lead in 2022? Again, these are just CPE questions. Give us some opinions. Get those answers in.
Get your CPE. Be interesting to see what people say here.
Well, I always like to joke that technically every SPAC is an IPO. So
technically.
That's right. Should have said traditional IPO or SPAC IPO. Somebody should have proofread these questions, guys, before. Just giving you a hard time. All right, we're at 60%. So, bump that up a couple more percentage points.
Yeah, ding, ding, ding. If you're just sitting there listening at your desk right now, now's the time to go back and just answer this question. Click one of them. Get your vote in.
All right, I'll close the poll.
There you go, 60-40. Thoughts on that? What do we think?
It's not surprising to me from what I'm seeing out there is, as the SPAC market cooled, everyone took a step back, it seemed like, and decided which was the best path forward for them. And I know, talking to a few companies, they've decided to take a step back and do the traditional IPO because they feel like it's more in their control a little bit from the preparation. They can be a little more strategic on the timeline than they can with the SPAC. I think it just depends on the situation for each company, right? I think there are some that the SPAC will work great. There's some that the traditional IPO will work great. There's some that a strategic sale through to a PE firm will work great. So it depends on the facts and circumstances, but that doesn't surprise me from a response.
Okay.
I think the data is there that shows that companies are going more IPO or direct listing than SPAC. I'm not surprised to see that 60-40 split.
Okay. Let's talk about the IPO filing process. What does that look like? And then we can kind of compare and contrast that again to the SPAC filing process and kind of talk about what this looks like. Go for it.
Yeah, so I think this is I think this is the right one to start with on a traditional IPO front, because it feels like for a while there, people forgot necessarily, maybe not forgot, but stepped away from the traditional IPO route, right? As everything was going SPAC crazy. I think one of the themes, I'm not going to regurgitate necessarily what's on the screen in terms of timeline, right? But one of the themes that we'll see between this slide and the next, which is the SPAC timeline, is predominantly that a lot of this underlying work that is there is the same for both paths, with some nuance depending on the route you take. So for a while, Jim Cramer was screaming on CNBC about how easy money the SPAC was and how everyone was going to get rich off these things, and it was Wild West. I don't think that's realistic from an accounting and finance standpoint and overall structure of the team and the company. You still have to be ready to be a public reporting entity at the end of this. The finish line is still, we're a public company. We still have to meet the SEC guidelines for audit, for reporting, for internal controls, for governance. None of that changes. It's more just the path in which you get to be that public company. Some registration differences between the S1 and the S4. I think we mentioned it a little bit earlier that the SPAC route is a little more hybrid between traditional IPO and PE, whereby it's more of a negotiation with the sponsor on what the valuation is. It's less market dictating as you price post S1. But realistically, the grunt work that lies under the surface is very similar. Your timeline might be compressed or not, but the general underlying pieces, they've still got to be there, right? If you want to be successful in the public stage.
Yeah, Tom, absolutely. And in this case, we're showing a potential 12-month timeline, which is probably about average, but certainly it could be extended, right? And many companies may need longer than that to get ready. So an 18-month or even a 24-month timeline is certainly reasonable and in some cases necessary.
Okay, any more comments on this slide? Let's look at the SPAC process. Then we have a couple questions we can jump to. We do see that consolidated timeline here. Let's talk about that, which is why the whole industry has been busy beyond belief. Talk about this a little bit.
Yeah, and so to Todd's most recent point, the timeline's compressed, and that's assuming that everything goes nice and smoothly and you're a very normal kind of run-of-the-mill. This is a very standardized timeline, right? Like this doesn't allow for, I was talking to one company recently, they wanted to roll in 9 different separate companies pre-SPAC merger and have all that roll into the newly formed public entity. Clearly that 6-month time frame, it's going to be a lot steeper climb to make that happen in that time period, especially if you're still trying to get audits done for the periods that would have to go into the filing. I mean, we're talking things would have to go pretty smoothly for that 6-month piece to come true. But again, the underlying blocking, tackling from a finance, governance, accounting team standpoint, it's all got to be there. I know Todd has got some insights related to SOX and internal controls, depending on when the SPACs filed their Ks, there can be some differences there. So I think that may be the biggest difference between these two. So Todd, I'll turn it over to you quickly.
Yeah, sure. Before I even dive into that, just some of the other considerations like corporate governance, right? When you're a public company, you have to think about having independent directors on the board and having financial experts on the board, building out an audit committee. That takes a lot of time and effort. Assessing the finance organization for readiness, optimizing systems and processes to be able to support financial reporting. So building out those capabilities and then establishing investor relations, right? Getting ready to do that on day one. Lots to consider on the front end. So when we say preparation, due diligence, and negotiations, that talks a lot about identifying the deal, right? The letter of intent, but there's all these other work streams in flight at the same time. In terms of SOX compliance readiness, as Tom alluded to, right, there are multiple components of dealing with SOX as a public company. The certifications that you make is one. The most commonly referred to is what's called Section 404 of SOX, right? And that breaks down to two parts: management assessing their own controls, and then whether or not a public company has to have their external auditor assess their internal controls. There are different criteria for that. If anybody wants some guidance on that, feel free to reach out to me. I can share some reference materials to help you think through that roadmap. But one key difference between a traditional IPO and SPAC is that through traditional IPO, a public company is given a 1-year grace period on having to adopt SOX. So even though you need to make your certifications in your filings, and obviously controls are important in terms of getting you to fairly presented financial statements, you don't actually have to issue a report on your assessment of controls. So that management assessment piece I was alluding to, you're also exempt from the external auditor requirement for the first year. Essentially, to be an accelerated filer or a large accelerated filer, you need to be a public company for 12 months. And so that buys you that first 10K filing where you're exempt and can adopt the SEC approved scope exclusion on that report. What's different in the SPAC scenario, though, is that the shell company is already public. So they may have already filed a 10K, and in which case they probably invoked that exemption. Depending on the timing of the deal, then you could be subject to management's assessment in the first year. You could also be subject to the external audit requirement, depending on how big your deal was, right? So if you're a large accelerated filer, you would be subject to that 404B requirement for the external audit. That's a real important consideration when thinking about the SPAC timeline, because it's a lot of work. Most private companies have not evaluated their internal controls. Their IT departments don't have the right kinds of formal processes in place to be able to stand up to a public company audit. And they probably don't have all the right entity level controls in place from a governance perspective to operate as a public company. It takes a lot of time to document processes and controls and then to evaluate them. So companies just need to keep that in mind when exploring the SPAC roadmap.
Well, and that before we move on from these slides, I think we got some questions that people are asking, and that goes directly to some of the cost or the investments that companies have to make if they're going to consider a SPAC versus IPO. Do we have any insight on comparing the cost of each of the transactions? Any thoughts there, or is that one more out of our wheelhouse?
I don't know. I can take a shot at it. I know, Tom, this is probably you or me, but you know, I think it's costly either way. Obviously, I don't think that one route or the other is cheaper. You know, you can see costs start to build up very quickly with a SPAC in this condensed timeline, and needing to essentially, you know, build a team so quickly and have many third-party advisors in a condensed period. Or you go the traditional IPO route and you have to build out, you know, a huge accounting and finance team, which is obviously costly as well. So it's a hard question to answer if you can really crunch the numbers and know. But they both seem very expensive, but you get, you know, access to capital markets.
Great.
Yeah,
Great.
I think the latest version of data that I saw, it was kind of 6 of one, half a dozen of the other, in terms of if you're trying to pinch pennies, it's not that either way is going to be expensive to David's point.
Great. And then another question was on the lockup periods for SPACs. It looks like the SPAC lockup period is about a year or more versus an IPO. It's only 6 months. Any comments there?
No, that's right. It's typically 180 days for traditional IPOs. I think the shortest lockup period is a direct listing, but SPACs are definitely typically longer from a lockup period at twice what the traditional IPO traditionally is.
Great. And then last one is any comments on D&O insurance considerations for private and public entities? Are there differences between SPACs and IPO with regards to D&O insurance?
I think that's a legal question. I mean, definitely out of my wheelhouse, but there's another question here in the Q&A about, SPACs having management in place. And you would want me to be very careful to vet. Oh, it's gone. But it's a great point that I wanted to bring up. That's vastly different than a direct listing or a traditional IPO, is that the SPAC comes with sponsors. So these are typically, entrepreneurs, seasoned people that have had successful exits. You wouldn't invest in a SPAC, in a shell company, if you didn't believe the people behind the SPAC are going to invest your money wisely. So, you've seen in the news that there's famous people involved with SPACs, et cetera, but it does come with, quote unquote, probably a few board members, right? They have their sponsors, they invested. And so that's part of the process, is vetting the management team. Is it a good fit for your company? Do they bring value to the table? I kind of think of it like Shark Tank, it's, do you want a team with these SPAC sponsors, and have they been successful? Are they going to drive value and help you navigate this new world as a public company?
Awesome. Okay. Let's move on to our next polling question. Go ahead, everyone. Polling question number 6. Now's the time to run back to your computers, find that box there to check. Go ahead, Deb.
Yeah. So polling number 6. What's the biggest difference? I can't see. Somebody really should have proofread these. What's the biggest difference between SPACs and IPOs? ROI, timing, expertise required. It depends. There's a reason I got a copywriting, guys. This isn't what I do. Make sure you get those in. About 52%. So I know there's about 5%, and we're getting up there. There we go. People are paying attention.
Everybody
Yes,
go ahead and
another
get your
minute.
answers in. Yeah.
Yep.
Thank you, everyone.
At our 60% mark here.
It's like our internal barrier. We got to break through that
I know,
60%
right?
number.
We're gonna get to 70. I don't know how we're gonna do it. All right, team. I'll close the poll in 3, 2, and 1.
Yeah. Any thoughts there, everyone? Yeah, we definitely saw the timing was a big piece of it. Yeah, you're going to need help no matter what. And there are a lot of factors there that it will cause it to fluctuate. Okay, with that said, let's talk about the learnings that we've learned over the last 12 months. And I think a great place to start here, David, is your comment about the team that you have in place, whether internal or external. I think that's a good place to start for everyone. And then we can kind of start to walk through these different boxes and what we've seen so far. So why don't you go ahead and start with that as a number one comment that, as you're going to go through this, what do you need?
Yeah, and it's really starting early and getting a team. And this is the term we like to say is that's been there and done that. And that's, both internal and external. So we see a lot of our companies that'll hire, seasoned CFOs or seasoned controllers that have taken a company IPO, but really it's getting the team in place that's been there and done that early so that management can go out and focus on marketing, and the actual transaction, and all this, the boring stuff that we're about to talk about, the readiness aspect. That's happening in the background while you're going out and driving value, for your transaction.
And when it comes to that team, would you say, are we seeing people do internal teams, external teams, a mixture of both? What are you seeing there that is kind of more popular today?
I think it's a mix of both, and you have to have both. So you can't do it all external. You cannot probably do it all internal without some third-party help. So I think it's both a mix. But I'll kick it to Tom, because that's where Tom can really talk to the dedicated project manager, and getting some quarterbacks, right? You probably need a couple quarterbacks.
Yeah, definitely. And Dean, to answer your question, right? I think in this employment market, we're seeing more and more people realize that professionals are in short supply. And so how do they still make everything that they want to happen when they cannot, happen, when they can't hire everyone internal? It's just, there's not enough people. I was joking with a client the other day that I'm in Dallas, and it seems like there's an arms race for technical accounting help in Dallas, and technical accounting skills. And quite frankly, that's something that I would have told you 3 years ago would be a ludicrous statement. I never would have thought that technical accounting would be in such high demand in somewhere like Dallas, right? We're not talking New York, we're not talking West Coast. I mean, Dallas it's growing, sure, but there's clear need across the country with everyone looking at this path. And so people need help. And as they're scaling, a lot of times people see a hybrid approach, whether they can lean and flex up is positive. To the point on program management, we see it most successfully where it's not left to the poor controller. I'll give them a shout out, right? And a lot of instances we get these poor controllers that are left to basically quarterback this from an accounting and sometimes an FP&A side with all of the forecasting needs and whatnot, because it is a small team and they don't historically have the army of folks behind them as they're looking to grow. They're a lean unit, typically on manpower and technology front. And so controllers trying to keep the operational books rolling down the track on the train, and also get everything coordinated in the background ready for this public process. And so really you need a person that can truly dedicate this, to David's phrase, quarterback the whole process, and that spans beyond just accounting, just finance, just operational, like how big picture can they make this happen? And without that, there's some downstream impacts. A lot of times you have a number of third-party vendors supporting, whether it be on tax on my side with sort of outsourced support and readiness, bankers, external counsel. How do you keep all those people moving in lockstep? Because another point that I wanted to bring up is it feels like accounting get looked at a lot of times as if they are performing a lot of this in a vacuum for the public filing process, when in reality, the legal team's got as big of a lift from a registration statement, if not more, right, from a compliance and regulatory standpoint. And so you really need someone that's going to act as the glue, as the thread to keep everyone moving in the right direction. It's easy for people to be sprinting in different directions, but if you can keep everyone coordinated, it's going to make it a much easier process for everyone. It's going to be more efficient. And these days, post-COVID, everyone's kind of gotten used to somewhat decentralized working. And so it makes it a little more doable from that person doesn't need a bum in a seat in an office. They can make sure that they're ringleading from wherever. And so, one prime sort of piece for the outsource or the hybrid model is the financial reporting need and prepping the external financial reporting. Private companies, unless they're really serious about going public and have got a really long kind of lead up to the process, they don't have an SEC reporting team. I know, Brian, you've been through the process before and you kind of went public and then had to hire the team thereafter, right?
Right. I mean, most private companies aren't geared up and staffed and spending all the resources to bring in the experts to go through a process like this. And I went through prior to Sarbanes-Oxley, so I can't imagine the scrutiny you get from the auditors today to prepare for an IPO with all the risks that are involved in it. So, I mean, there's a lot of work that goes into it. And most CFOs, that might have been the controller and worked their way up the company, if they don't have prior SEC experience, you've got to go out and get that, bring that in or outsource it, as Tom said. It's a big risk for a company and a big cost to prepare their finances to be prepared for the scrutiny.
Yeah, I think one of the questions we got was, does location of skilled team members matter in this era of work from home? I mean, I think that depends on management and the approach that company wants to take. I know Dropbox is fully decentralized, right? They're fully work from home. I think it might be difficult if there's parameters on they need people to be in a certain location. It's going to limit, right? From a skill set and reach standpoint. I think part of it depends on the team and how that company is choosing to manage. But I would argue many people have gotten very used to Zoom these days to where you've got a lot more acceptance of that kind of decentralized approach.
Yeah, Tom, if I could add to that too, because it's appropriate since I'm at the AICPA Forensic and Valuation Services Conference, a lot of the forensic topics are on the work from home risks and the extra work that the auditors need to do to make sure the segregation of duties and the controls are working just as if everybody was in the office. So, a company preparing to go through a SPAC or an IPO, and if they've got their accounting department or key resources that are doing forecasting, FP&A, obviously accounts payable, working from home, you've got to make sure you've got the controls in place.
Yeah, I talked about management mindset, right, from working from home, but also does the company have the technology to be able to successfully work from home? Like, do you have a closed automation system that pushes everything to the cloud, which means you can be in Florida and Washington State and people can be working together and there's no issue. I mean, that's one area we saw at the beginning of COVID, everyone kind of pivoted to scramble to try and get cloud-based technology systems because maybe they're on QuickBooks desktop previously, and now all of a sudden people aren't going into the office and they're scrambling there, or they're still, on paper invoicing. And so how do people get access to that information from outside of the true physical office? And so, yeah, from a work from home or not, there's a lot of considerations. Todd?
Yeah, Tom, I was just going to add that companies who have been on a path for planning for a traditional IPO, I think, tend to start some of that work earlier, right? So that they start to build out their team. They start to have a technology roadmap for implementing an ERP that can facilitate that sort of control from a remote work model. A lot of the SPACs we're seeing, right, are not in that position from a technology perspective. We have seen companies go public still on QuickBooks, right, which is very uncommon and certainly would have been deemed a big red flag, right, in years past, going through the traditional IPO markets. Regardless of the timing of the deal and whether it's IPO or SPAC, right, that has to be considered. I think the work from home model will continue to evolve for sure. And as you pointed out, it does tie back to corporate culture, right? What is the culture that the company is building? Another model that's commonly adopted as finance and accounting orgs are built out is that those groups may be part of a shared service center, right? So they may not even be located in the same market as headquarters, where you have higher priced talent on the business side, whether it's in the tech space, right, with engineering talent, or whether it's the sales team or the senior leadership team, right? But often CFO orgs can be built out with accounting talent in lower cost markets.
Great. And then the last one, I mean, we definitely covered the program management outsourced services. Any last comments on financial statements and disclosures before we move off of this slide, gentlemen?
My feedback is just the scrutiny is only going to go up, right? As you get closer to the public, call it finish line. Really, it's not finish line, it's more of a starting point. But as you get close to that public inflection stage, I mean, the audit that you go through before you go public for your filing, the level of scrutiny and the number of eyes on this is going to go up. So the level of accuracy is going to have to go up. Your close process is going to have to tighten to be able to meet the SEC reporting deadlines. All of a sudden, you've got, likely Big 4, Big 10 technical offices crawling through your technical memos. You've got new tax considerations that are going to be involved. You've got to make sure that you're doing your stock comp on a monthly or quarterly basis instead of an annual basis. Even things like your 409As, right? You've got to increase the cadence for those as you approach the go public piece. And you've got to be able to adopt accounting policies oftentimes with the public companies. Obviously, there's sometimes, you get some relief depending on your filing status as to when you adopt those. The auditors have to really be hands off. They can't be giving you the guidance maybe that they've given you for years and years because of that level of independence they have to provide to the outside markets. And the only other caveat I would say to this, right, so far is all of this has been talking about just getting to that public reporting entity mark. Something that I like to talk to my clients and people that I'm talking to about this is it's not just day one, it's day 2, it's day 100. You've got to be able to do this on an ongoing basis. It is not a get it done once and you check the box. Sure, the go public process is, but the rigors that come with all of this are a continual piece into the future. It's not a one and done element. You've got to be able to keep up with this as you do your normal monthly close, right? So there's a lot of considerations to go in.
And we're going to cover tax prep in a couple more slides, but David, real quick, with regards to the financial statements and disclosures, any thoughts with regards to tax provision and those types of items?
Yeah, I mean, I think there's a couple slides on, tax readiness that we can get into, but, one of the things this is learnings from the field. And I think one of my big takeaways was we had to see companies pick new auditors in a very quick time frame. So, Tom was talking about you're going to have to, possibly adopt 606 or 842 on an accelerated timeline, and your auditors can't just, give you the advice. Well, the problem is maybe they did back when they were doing AICPA audits and they crossed, certain, independence lines that now in a PCAOB world, they are now no longer independent. So we saw a lot of clients and targets that had to onboard a Big 4 or Big 10 in a very, very short period of time. That's kind of one of my key learnings from the field, was seeing how many clients had to pick a new auditor, which I think might be valuable for the audience. That if you're thinking about a public transaction, think about your auditor and are they independent from a PCAOB perspective.
Yeah, great learning right there, David. Okay, let's move on to the next slide. Let's talk about Todd, SOX readiness and support. What are some of your key learnings that you want to share with everybody tuning in right now?
Well, first and foremost, it's just the challenge of competing priorities, right? It's getting ready for the audit. Everything we just talked about on that last slide is all about going through the multi-year PCAOB audit uplift, right? You're going from AICPA standards, as Tom and David alluded to PCAOB standards. And even though you're not yet subject to the integrated audit for SOX purposes, you are still going through a PCAOB audit where the auditors will need to understand and evaluate your controls. So the distinction there is they're not issuing an opinion on your controls, but they're still required by professional standards to understand them and evaluate them. And that opens up the risk of potential public disclosure, right? As they evaluate your technical accounting and they evaluate your process and controls, you could have multiple material weaknesses in the control environment that would need to be disclosed if they are known at the time of the S1 or S4 filing. In terms of the competing priorities I was alluding to, right? Whether it's traditional IPO or SPAC, controls and SOX readiness tends to be the last thing on the checklist that people get to, right? Usually a public company or a company going through traditional IPO, they may hire a director of internal audit, shortly after actually going public, and which means that that person coming in is behind the 8-ball in terms of trying to evaluate the controls and get a program in place for sustainable compliance. In the SPAC world, with the compressed timeline, obviously there's even more pressure. The external auditors will be asking for controls documentation as they're doing the PCAOB audit, but most companies can't get to it that early in the process. They're too busy cleaning up their books. They're too busy writing the technical accounting memos that Tom helps his clients, right? And they're too busy working with David on understanding the tax implications of the deal. So what we typically do is try to start with a gap assessment, and that's a process that's not audit based, right? It's more of an interview based process where we build out a roadmap of assessing financial statement risk, figuring out what would be in scope from a SOX audit perspective, and then evaluating all the processes that ultimately produce the numbers in the financials. We identify the controls that are in place, that need enhancement, and the gaps that need to be implemented. And it's really important to work with someone who has experience doing this and isn't just going to take a checklist or cookie cutter approach, because with the complexities of running a private business and the constraints on resources you have, you can't take a one-size-fits-all approach, right? You got to take a risk-based approach that thinks about your people, your processes, and your technology, and what's feasible from a control perspective. You need to work with someone who works with all the major external audit firms to understand what their quality expectations are going to be, and that as you move towards directionally being under an integrated audit in the future, right, what kinds of documentation will they expect? The expectation for controls just continues to go up as the PCAOB scrutinizes the external audit firms and evaluates their work. After going through the gap assessment and identifying all the things that need to be fixed from a controls perspective, we build out a timeline with our clients and then think about, okay, how do we get the process documentation in place? And then what is the right time to start testing and evaluating controls? Some clients like to do it before they're actually subject to SOX, just as a dry run to help all their stakeholders become familiar with what that rigorous audit process is going to be like, both internally and externally. And others wait until the year that they're first subject to SOX. Again, it depends on whether you're subject to only 404A, which is management's assessment, or whether you're subject to 404A and 404B with the external audit, in terms of how you're going to partner with your external auditor, what kind of feedback they're going to share, and how much testing you're going to do to support your conclusions.
Great. With regards to filing and readiness, what learnings jump out? Any key insights that we might have to share with our audience today?
I would say from my side, we've seen technology in this space really support that process to where it's not version control issues with Word docs that are getting sent by email. For example, Workiva is a platform we really like working with, because It's all linked. It's all live. It's effectively a combination of Word and Google Sheets, right? For those that aren't familiar, but it means that you can have multiple people in there at the same time, whether it be legal or your CFO, controller, external parties, and you can track edits. You can revert edits if people don't like changes that were made by anyone, and you basically have the ability to brain share on the fly, and you don't have to worry about the version control, which anyone that has been through the process of sending static Word docs for filings through emails, through groups of 25, 30 plus people, know how painful it is when you get a version that was 3 versions old, get circulated as if it's the latest and greatest. And this is, the filing is where I was referencing earlier, right, with the legal team. Legal team do a heavy lift on this. Accounting do clearly there's involvement. It's still a finance filing, but a lot of it is legal. So it's a lift. Don't underestimate the lift, including the risk factors and getting that involved early.
And we do, I see that ESG evaluation there. I mean, that is something that is, the NASDAQ came out and they wanted to see all the companies make sure that they're compliant there and have some comments around that. So I think that just another area that I think that, you know, organizations are teaming with experts externally to kind of to get compliant and be ready to go down that path as well. Okay. Any other comments here? We can go to our next slide, which talks about digital transformation, audit prep, tax prep, and you know, the transaction doesn't stop the second you go. Actually, post-transaction, what can we talk about as well? So let's share some learnings here. Maybe we can start off with digital transformation. Oh, and don't worry, Wendy, you haven't missed a polling question. It's on the very next slide. Okay, digital transformation. Any thoughts or insights here?
I think, Tom, that goes back to what you were talking about, and I know we have a Q&A on, you were talking about Google Sheets and Workiva.
Yeah, and you know, Todd touched on it earlier too with QuickBooks, right? I mean, a big piece of this from a human capital standpoint and from an ability to scale within the finance and accounting team is taking a good hard look at whether you have the tools underlying to be able to achieve everything that you're trying to throughout this transaction. So are you still on QuickBooks? All right, it's probably time to take a look and see what might be a good fit for you on a go-forward basis. You may not need a full Oracle or SAP, but you know, there's a sweet spot for you as to where you are and where you anticipate being. And that's just from a modern ERP standpoint, right? You've got other pieces like, do you need a close automation tool like Blackline to help the operational elements and making sure that everything's moving smoothly towards that close process? I mentioned Workiva for a SEC reporting standpoint. Are you planning on doing it in-house, or is that something that you're going to work with a third-party provider to basically supplement and support you on? Again, everyone thinks that everyone can work more hours, right? Because of the work from home, and everyone's gone from working from home to, what's the phrase, living at work. And so it's whether you can do what you need to do with the tools available, and can your people be providing more value than just worksheet jockeying between, you know, picking it out of one system, dropping it into another. And this goes beyond accounting. It also includes things like adaptive insights for forecasting and budgeting. How well are you set up to be this, you know, best-in-class public company, right? That you're looking to be.
Well, Tom, and when you talk about that being a best-in-class public company, I think that digital transformation extends past the business office, right? Or the finance and accounting team, right? I think it's not just paper to PDF or implementing cloud software or integrating your finance and accounting software, right? I think now what we're seeing is the most sophisticated the best organizations are going through a digital transformation, right? Like Microsoft is saying by the year 2025, 95% of transactions will be between a human and a bot. We have other organizations that are saying we're not going to, some fast growing organizations based out of Silicon Valley that, we're hearing their controllers group saying that we're not going to add any new controllers. We're going to raise the level of what they're going to do, and we're going to incorporate more AI and bots and artificial intelligence into our systems and processes. So I think the digitization of our business and just kind of the move forward into how we're going to interact with our clients and our customers and how they're going to buy our services is really some of the things that when it comes to digital transformation that the leading and best performing organizations are doing. Okay, let's talk about audit prep and audit support. I know this is very boring, but this is a painful process, especially if you had to choose, right, David, your auditors on the fly very quickly because maybe before your auditors did so much for you and now they can't any longer. Let's talk about that.
Yeah, I'll just add that in addition to David's point about possibly having to select a new auditor, keep in mind how backlogged all the firms are, right? And the ability to sign someone up and get a team deployed to execute multi-year audits right away is going to be a huge challenge. So that's one of the biggest issues our clients have seen as they try to move to the public markets in a compressed timeline. Even the big four are saying they're sold out.
Not just that, right? But the pain of having to walk a new auditor through everything about your business that they have to get comfortable with, whether it be processes, rev rec cycle. I mean, it's start from the ground up, right? And not just that, but you're also upping the ante from a materiality standpoint, from a testing scrutiny, from how much maybe goes to a national technical office and gets beat up there. And so there's a lot that goes in terms of those uplift procedures, even if you're with the same auditor. But if you're starting with a new one, it can be more painful.
One of the key points is highlighted in a bullet here, and that's to make sure in working with your external counsel and your external auditors that you understand whether you need to share 2 years of prior periods audited or 3 years. And the criteria there is spelled out related to emerging growth companies and smaller reporting companies that limit it to 2. So for the average size deal that we were talking about early on, they can probably get away with the 2 years of audited financials. But for larger valuations or companies with lots of revenue, they may be subject to the 3-year period.
So maybe I can just go through some of the tax items since we haven't really talked much about that. It's probably, talking more about just what we're seeing in the markets, et cetera. But at the end of the day, I'm just ultimately a tax guy. So this is more around, the GAAP readiness, SEC filing, not necessarily like pre-transaction structuring, et cetera. That's really what this is focusing on, is getting you SEC ready. And so from a tax perspective, if you've never done a provision, if you've never had audited financial statements, that's going to go along with the 2 or 3 periods that Todd was referencing. You might have a whole new audit firm that's going to take a fresh look at your tax provision. And you're also going to do quarterly financials. So, private companies only have to do annual financial statements, annual tax provision. Now you're having to go back in time and do a provision every single quarter. So we see a lot of uplift there. The last one is, the last bullet point is actually what we see the biggest scrutiny, is FIN 48, or that's uncertain tax positions. That's a big scrutiny item, not just when you're going through a new audit, but also the SEC. I would say FIN 48, valuation allowance on your deferred tax assets. Section 382 relates to your tax attributes. There's a whole new focus on tax, I'd say in general, within the last probably 10 to 15 years. the capital markets didn't care as much about tax and tax attributes as they do today. Now, bankers and the PCAOB and the SEC are starting to ask a lot more questions around tax and tax attributes. When I say tax attributes, I mean net operating loss carry forwards, R&D credit carry forwards, interest expense limitation carry forwards. Tax is starting to really come into the fold, whereas it was kind of a side thought before. And so these are really areas that you need to have cleaned up. The reference here to ASC 450 accrual, that's really like your sales tax. That's your non-income tax. Your property tax is your sales tax. Sales tax is probably the number one we see here. With Wayfair passing in 2018, the complete landscape of Nexus has changed. So Nexus studies for income tax and sales tax are critical for this kind of go public, go SEC strategy. And then that middle point is just, if you are international, right? And you have international operations, a lot of times you don't have your transfer pricing up to date. You've been running with maybe a cost plus model, and you picked a percentage a couple of years ago and you've just been using that. So these are all areas that go along with everything that, you know, Tom and Todd were talking about. It's an uplift to a PCAOB to SEC scrutiny. And so that's kind of what it looks like from the tax side. And so I see a comment here about post-exit QSBS. We are flooded with 1202 QSBS studies. It is a hot topic right now. It's could possibly be impacted by tax reform, that there are 1202 QSBS language in what is most recently being floated around Congress. And so that's definitely a consideration that founders need to think about, is doing a QSBS study and understanding if they have qualified small business stock and if there's some tax savings there. That's a great question.
All right. Any other comments on post-transaction services before I think we go to our next polling question? What other insights or learnings here post-transaction do we want to highlight? And then we'll be moving into down the stretch and wrap this thing up.
I would just say, to keep it brief, right? Don't overlook it. Don't look past the need beyond that transaction date to have a plan in place. Don't wait until that point to actually start thinking about how you're going to make this work. Start thinking about it early. Start laying the groundwork. I know Todd and his team do an awful lot from SOX standpoint. Post-transaction, we support people with an SEC reporting framework as they are trying to scale. So maybe I'll be quiet and let Todd talk.
Well, I'll just add that a lot of companies trying to get to the finish line go through the readiness assessment, but then hit the pause button on their SOX program, which ultimately ends up having all the documentation that was prepared become stale, right? So the money that was invested to prepare documentation and circulate it across all the control owners in the company just collects dust on the shelf, and then they sort of need to start over if they wait until the year they're first subject to the external audit requirement. One other distinction I'll call out is just noting if a company is looking to enter the capital markets, understanding that the New York Stock Exchange has a specific requirement for their registrants related to having an internal audit function. NASDAQ does not explicitly call that out, but it's just an important thing to keep on the radar. So it generally relates to evaluating internal controls. So that's the SOX piece. And the other piece relates to evaluating management's process for risk management. And both of those things can be accomplished with an in-house team or an external service provider. We serve 30 plus public companies in the internal audit and SOX compliance space, and we help them achieve that requirement.
Awesome. Okay. With that said, we are going to do polling question number 7. So everyone, please get in your answer to this question, and then we're going to take a quick break and move into our last section on private transactions. Okay, with that said, go ahead, Deb.
Yeah. Polling question 7. So what is the most important part of the public offering readiness process? Project management, financial statements, filings, or tax and regulatory compliance? Those answers in, we're at about 58%. Give it just a couple more minutes or a minute. Still at 60. All right. We'll close the poll in 3, 2, and 1.
Awesome. Good to see that having someone. Everybody heard what Tom had to say in the very first slide here. That project manager is very crucial here as well, and then making sure you built out the team. So that is good to see. With that, Deb, did we have time to take a quick bio break, or should we just get right into the content?
We can't. I'm gonna actually skip these because I want to make sure. Let's take a quick 2-minute break, just real quick.
Okay.
And come back, and then Brian will be on deck.
Great. Thank you all. All right, Deb, maybe we can catch everyone up just with regards to where we are for the CPE and the questions. Just so everybody knows, we've had 7 polling questions so far. Is that fair, Deb?
That's fair.
Okay. And so if you've got I think we need to get, how many of them? 80 something percent. I can't
Yep, we've got
remember.
five more coming up.
5 more questions. And with that, we will get started. Brian, let's get moving into, looks like, do we have another polling question to start?
We do.
All right. Well, here's another one.
You know, like I knew what people were here for. No, I'm just kidding. You're right. Let's get this rolling. All right, polling question. These should be popping up. If they're not, again, email me. I'm assuming it's likely a technical error on somebody's side, but I think most people are seeing them. So poll number 8, when will the M&A market cool down? 3 months, 6 months, 9 months, never. I'm very extremist here. It's a couple of months or just never. There's no in between. At about 50%. Get everybody back in their seats.
All right, let's move forward.
All right.
When will the M&A market cool down? I knew it was going to say never. I knew it. It's never going to stop, Brian. What are your thoughts on that?
I tend to agree, as I kind of started off earlier, Dean, with the pause last year and COVID. I mean, literally running the transaction practice, that third week of March last year, we were told to drop pencils, no more work. Everything was on hold in the transaction world. And then, as the summer recovered, heading into the fall, things really picked up to prepare for 2021. And then in 2021, with the tax proposals that are out there, a lot of private owners have gotten advice that it might be better to take advantage of the capital gains tax rates and other tax advantages before the tax changes kick in. So it's almost like we're trying to cram 3 years worth of transactions into 1 year. But, as I go to these conferences, I talk to other investment bankers and private equity leaders, I don't see it slowing down anytime soon. I'm not sure if I'll talk about it on some of these slides, but we're going to show a lot of information about private equity and how much money private equity firms are investing in transactions. That there's statistics out there that in the next 10 years, 7 out of 10 business owners will go through some type of succession. And the majority of the successions to outside investors are going to be by private equity firms. And there's just so much dry powder and investment money out there to invest in buying private companies as either a platform company or a role. Going to continue to grow and expand and be very active. Deb, if you want to kind of move the slides for me. And I think a lot of these slides are going to tell the same story. I was a little bit surprised to see that the global M&A activity is not accelerating like we talked about on the U.S. M&A activity. I'm not exactly sure what's driving that. We've been contacted by a number of international firms that were looking at investments this past year and to do quality of earnings and due diligence work. And so I know they're still active. I don't know if COVID's had a more prolonged impact on some of the international firms that are looking at acquisitions, but I would expect that to continue to increase. Not sure how to interpret some of these slides. There's a lot of colors on here. I kind of look at the industry sector, which is interesting because a lot of people talk about healthcare being a really active industry, but when you look at IT, and if you combine the two, if you have a healthcare IT company, those are areas that are really active in M&A. Private equity firms are really investing in heavily. You've always got the business products, consumer products firms, but I've seen a pretty good uptick, it seems like, in the healthcare IT area. So here's more of the North American M&A activity, which obviously would pull into Canada as well. I'm not sure how active Canada is. I can speak to the US being extremely extremely active.
Yeah, just Brian, I wanted to jump in real quick because you actually, I think, brought it up earlier around tax reform, right? And we have a Q&A on, cap gains rate is looking less likely now. And I think, that statement is true. The two, moderate Democrats came out and said we have to do this without raising rates. That's how it currently stands in the world today. But I think what's driving a lot of this M&A, and I'm seeing this with a lot of my private clients, is just the unknown, right? Is just let's have a liquidity event in 2021 just in case, right? And a lot of these tax reforms are, backdated and retro, so you can't plan around it, but it's a lot of unknown, and let's just go through a liquidity event. So I think that's a big piece of it too. And I know you brought that up at the very beginning of the webcast.
Yeah, and of course that only impacts the US, this North American slide, which would have Canada and also Mexico in it. I've actually seen more activity and investments in Mexico versus Canada. And just in one situation, we had a client that there was a restricted cash in Canada, and it was very difficult to get that money out of Canada without significant tax consequences. But I'm not sure if that's what's driving this a little bit of a downturn. But the other sides, the estimated deal value and the deal value are obviously going up. So just again, supports a lot of activity.
Great. And we can go straight into, I think the next slide is US PE deal activity. Right there, you go.
Yeah, and this is the world I live in. Going to so many private equity conferences and being in charge of the private equity industry for the firm. I mean, there's so much money out there. Everything I see is every quarter there's a new record for fund money raised, which is obviously being used to invest in companies. But there's also a lot of family offices that might not quite qualify for PE deal, but they've got private wealth and they're acting like a private equity firm by buying companies to diversify their investment risks. I attended an event last year that said there's now more family offices buying businesses in the US than there are private equity firms even. So that was an interesting tidbit. And I think sometimes they all look the same. Some family offices are long-term holders, and others are, they're looking to make money and turn an investment just like a PE firm would.
Great. And,
I will just add on that slide prior. I know we were talking about multiples earlier, and what we are seeing driving some of the deal flow is the private equity firms are starting to pay higher multiples. I mean, some of them are very disciplined, but they are starting to pay more. In the past, it used to be strategics would pay the higher multiple because they would get synergies out of the transaction. But a lot of the private equity firms are starting with the platform and paying a decent premium to get involved because they're going to do a lot of roll-ups and a lot of buy and build to grow. And they believe that they can exit at a higher multiple if they do all the right things along the way in growing that business.
Great. And then let's go to the last slide, Deb, to talk about the take private activity here. What is this saying to you, Brian? Are you seeing this in the marketplace as well?
Well, I mean, it's not as pervasive. I mean, the Dell story was out there, how Michael Dell went private, then he went public again. But it is happening. It's just usually private equity firms have to really pay a premium to buy a public company, and then the cost to go through taking them private when there's so many other private companies that are out there that are available.
Okay, and I think that takes us to polling question number 9. Deb, take it.
It is. All right. If you could guess what % of businesses put on the market actually sell? Less than 25%, 25 to 50, more than 50. Wanted to tee this one up for you, Brian,
Because I know what the next slide says, yeah.
That's right. All right, get those answers in. Get your bell, Dean, ding, 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 polling question, polling question. Make sure
That's
folks are paying
right.
attention, you know.
Find that box. Click that answer here. This one should be interesting. I think this is going to be very insightful, Brian.
Yeah.
Where are we at?
We're at 58%.
Oh, we need a couple more to get to
Get
our
'em up.
average. Come on, everyone. Moving right along here.
Everybody, just a few more moments. I'll close the poll in 3, 2, and 1. All right. Looks like 25 to 50 won that one. So, were they right?
Well, we'll find out.
Move that yeah, let's see that slide.
So, you know, I've heard prior to doing the research on this one that 70% of businesses don't successfully go through a sale process. The research we did said 80%. It could also be the definition of put on the market. It could be, you know, they just basically tried to sell the company to a proprietary deal. And a lot of those just don't go through. But I've heard a lot of investment bankers who have tracked a lot of their deals that they've participated in, and they never see that the deal closed. So there's a lot more failed transactions that just don't go through for all kinds of reasons. And so, you know, this section, I don't want to bore everybody with repeating a lot of the great information that the prior sections shared about how to prepare your company for an IPO or a SPAC. I mean, obviously that's kind of preparing yourself to buy a Cadillac or a Tesla. Where a private owner, there's a lot of things though that you can benefit from learning what, you know, a company is doing to prepare to go public. You don't have to nearly spend those fees or be that prepared, but there's a lot of great things that you can do to enhance the value of your business and be prepared. And, you know, if there's nothing else that you walk away from this part of the presentation is you can't start early enough. You know, 5 years out is a good planning. Too many times you see guys talking around the country club table, and I know every business owner is getting calls weekly, monthly, letters. I mean, these private equity firms are hiring people out of college to just go out there and do market research and call every single company that they can find, trying to make offers, get to LOI stages. And every now and then an owner here's his friend at the country club talking about how much money they made, and they think, oh, let's just go sell the company. And too many times the accounting firm gets a call from the tax partner, or the tax partner gets a call. The client's already signed an LOI, and they're like, what do you think about this? What do I need to do? What are my taxes going to be? And by then it might be too late, because there's so many things you could have been doing to prepare yourself. You know, this state of owner readiness, and get ready to prepare your company for sale to maximize the value. There's a question earlier about quality of earnings. We'll cover that. More and more sell side quality of earnings are being done, which are way different than having an audit done or a review or just having even good internal financial statements. We can go on to the next slide. You know, this kind of, again, talks about kind of the exit planning process. It's, you know, knowing the value of your business, preparing your company for sale, and then really deciding, do you want to invest and grow the business, or just exit? There's so many different things that, you know, an owner needs to be thinking through. And that's why it's not something that just because you get an offer on the table, you should just jump and start working through a sale process and assume everything's going to work out well. And that's, again, why so many deals crater in the end. Again, this is just more of a visual about all the different types of entities that are out there and all the different choices to have to think through. I mean, it's to prepare a company for sale, whether it's a stock sale and an asset sale, different types of corporate structures. You know, is there going to be seller financing, an earn out? rollover equity, so many things to think through and be prepared for. And the more prepared you are to go through the process, the better you'll be in the end. I think that slide before said a number of owners are disappointed, 2 years after the fact, and wish they wouldn't have done it, even if it was a successful process.
Yeah, I just wanted to jump in here. And Debbie, why don't you just launch the polling question while I kind of talk a little bit here? Because obviously, deals, the structure of what you're selling is a big part of the exit strategy and how it's taxable to you. And one of the items that we didn't cover during the kind of SEC section is we are seeing a huge influx of Up-C structures. So for one reason or another, you may still be a partnership and want to go public. And so we've seen a lot of Up-Cs and a lot of Up-SPACs, which can create a ton of value to those pre-IPO investors. So deal structures, obviously, to your point, Ryan, I love getting the call before the fact, not after the fact. But sometimes you got to deal with it either way.
Yeah, I don't have any statistics on this, but I would say that my gut tells me that the majority of transactions that I see fail are usually because of taxes or a potential working capital issue that the seller, their professionals, whatever, they hadn't prepared for. And a lot of times I've seen investment bankers, they get a seller to sign up an engagement letter with them to sell the business, and they hadn't even talked about the after-tax proceeds that the owner might put in their pocket, or the complications that could be there with the tax structure, and the buyer wanting to propose an asset purchase when the seller needs it to be a stock purchase, and trying to figure out how to work through that.
Yeah.
All right, real quick for those that are away doing something else, quick polling question 10, get those answers in. Want to make sure we get through all this good stuff. 56%, 57%, 58%. Look at this, people. Come on, keep going. 58%. Give you a couple more seconds here, and then we'll get back to Brian. I have a feeling he's going to talk about valuations here shortly. So how important are valuations in the selling process? Very important, somewhat important, not important. Again, if for some reason you can't see the poll box, let me know. Please email me. We'll solve this. I just basically need an answer. Poll question 10, answer A. That's, shoot me an email. We'll solve this following the webinar. All right, I'm going to close the poll. Very important, Brian. Good news.
Good answer. Yeah, our firm does valuations for all kinds of purposes. We have a lot of clients who just ask us to come out and do a valuation, kind of as a state of the union, to understand what is my company worth and did it improve over the last year or maybe 2 years prior. And it's also, and David probably will talk about this too, is the other thing that happens is when an owner's getting ready to sell the company, and then they say, oh, but how can I lower my taxes by gifting some of my shares to my children or my heirs, or do something special with it? And, the IRS kind of frowns upon a valuation being done at a tax discounted price, and then 3 months later, the business selling for double that. So, those are things to prepare for well in advance, but there's all kinds of ways to do a value, or to have a valuation done, all kinds of value in having that valuation done. And the best thing is when you get that caller calling you up saying, I want to make an offer on your company, which some PE firms do. It's good to have a good idea what your company is really valued at, and all the drivers of enhancing that value and the things that could be eroding the values that you could be working on to improve. And we talked about all those earlier, so we can go ahead and kind of move forward. Yeah, this goes through, I just use the term value drivers and detractors. As we do a valuation for an owner, when they come to us and they say, I was surprised about this, or I was disappointed in this, we usually have a good reason as to what was driving those values and the rates we use. And we're always good about sharing those and offering suggestions on things that we see that you could do to improve those. Some are easier than others. It might not be easy to change a customer concentration issue. It might be tough to, really improve your books and records to provide better financial information, but those things can all be worked on if you prepare in advance. We can go forward, Debbie. Quality of earnings. Yeah, this came up earlier. So like I said, I'm seeing a big uptick in the number of quality of earnings being done. A big driver of that is that 8 years ago, when I started running the transaction advisory practice, investment bankers were basically going to owners and saying, I think your business is worth $100 million. And we just need you to give us your owner discretionary expenses that you're running through the company, and we'll treat those as add backs. And we'll put together these hockey stick projections and we'll sell your company for the highest value we can. Well, too many times the buy side diligence, especially as the multiples started increasing and private equity firms started hiring good accounting professionals to come in and tear up the numbers, they found revenue recognition issues. They found unsupported expenses, unsupported income numbers, just lots of issues that made the investment bankers say, there might be some value to have these numbers scrubbed in advance. It helps us prepare for what the buy side might be looking for. And so we've seen a big uptick in quality of earnings on both the sell side and the buy side now. And as I go to a lot of these conferences and talk to competitors, I talk to a lot of our competitors who say they don't have the capacity to do these and they're turning down work. And this is the greatest way on the sell side to add and maximize the value, is to prepare a good quality of earnings. And it's different than an audit. It's different than a review. It's looking for really the diligence adjusted EBITDA numbers. We can go forward. Net working capital, I mentioned this earlier. It's something that at the very onset of a transaction, even before the LOI, an owner should be working with their professionals on this. Working capital is not as simple as the accounting definition of current assets minus current liabilities. There's a lot of analysis that goes into this, and it's a negotiated number just like the purchase price. And if you're unsophisticated on one side of the transaction, a sophisticated person, buyer or seller, could take advantage of that. I mean, this is an area that has a lot of scrutiny, gets a 90-day clawback window after the deal's closed to come back and really true it up and adjust what was agreed to at closing. Just a lot of work goes into this. Don't want to underemphasize this slide. And go on.
Brian, when I see this slide, it really ties into, a lot of that get your house in order, get ahead of it. These adjustments, these diligence adjustments, these go straight to the dollars that are going to hit your pocket. So let's walk through these real quick.
Yeah, these are the things that it's surprising sometimes when I talk to a business owner about doing a sell side quality of earnings, and they say, well, I have very clean books. My tax account won't let me do anything. And it's not that we're looking for country club expenses and boating expenses and second houses that are running through the books, but there's just lots of different items that are unusual in nature, non-recurring, accounting errors, changes in accounting policies that could affect either the prior financials that need to be restated or pro forma financials. There's out of period adjustments, timing issues. Some companies wait until the end of the year to record property taxes and certain accounting entries. Sometimes their accountants do it after year end. There's just so many areas that when we go in and look for these things, we're able to add those back to your EBITDA number, which times a multiple increases your value. audited financial statements are trying to come up with net income, not EBITDA. And so that's why doing a quality of earnings in advance can prepare for then the buy side coming in, looking for the opposite of these things. Because the buyer's diligence team are not going to point out things that would increase the value. They're only looking at things that should be challenged to try to lower the value. And I always try to advise owners, once you sign the LOI, don't expect the value to go up. Usually it's going to be a negotiated process, and it's more likely that it could go down again, resulting in why 70%, 80% of deals don't go through.
That's good insight right there, Brian. Okay.
To keep us on pace here, so we have time for some questions. So again, this thing, as we talked with David, I mean, so many times owners get too far along and then they ask their tax accountant, it's like, well, how much money am I actually going to put in my pocket? And that's when they find out that, you know, their tax structure might not have been set up properly. They might not have negotiated the best tax structure going into the transaction. And then they find out it's not as much as they thought it was going to be. And then their wealth manager tells them, you can't live off that money the way you were living off the business.
Yeah, and the only thing I'd add here from a tax perspective is, you know, when a seller's considering, or a buyer, a 338 election, you know, to treat a stock sale as an asset sale or whatever, sometimes you have to do this math that we're looking at to really show the buyer and the seller what the true after tax cash impact is. So obviously the most important number on here is in yellow, right? That cash.
And I think what we do really well too as a firm is we reach across the table and help an unsophisticated tax professional that might be, you know, the company's tax account or company's just corporate tax accountant, to kind of help them work through what a 338 election is, the difference it can have in value. Because in the end, I always like to bring our tax guys in to create a win-win situation for both sides, because they need to understand what the tax consequences are. So they're going in with their eyes open and they're not surprised at the end. So, move forward.
Right. Polling question 11.
Oh, we are almost there, everyone. Go ahead, Deb.
That's right. Which of the steps, which are the key steps in any M&A transaction? Pre-planning, pre-deal planning, transition planning, post-close planning, all of the above. It's a lot of planning regardless. So, you know, get those questions in, or answers in to the question, but also get those questions in if you've got any questions that you want the guys to answer. We're going to get to that in just a second here.
Yeah, answer this question, especially if you couldn't see question 11. I think you're allowed to miss one or two. So let's make sure you get in question 11 here.
Yep. Yeah, and for those that have had issues with the polls, again, don't worry. We'll handle it. We'll take care of you after the webinar. So, all right. Again, we're up there about 60%. It's our sweet spot today. Get those answers in. We'll close the poll in 3, 2, and 1. All right. All of the above.
Good answer. I assume that's what the next slide's going to say, Debbie. Yeah. So all of,
like I knew this day,
yeah.
Brian.
Yeah. I mean, all the things everybody's kind of emphasizes, all the planning that goes in, as Debbie said, planning. And you can never start too early. You can bounce to the next slide. So again, start preparing now. All we can kind of, if you, like I said, if you can walk away, there's so many things that we can help you prepare for to go through the sales process. The one company I also mentioned earlier that's supposed to close on Thursday, a couple of things they as they went through the process, they realized that they could do an add-on acquisition and then a second one. and they were able to merge those companies in, and they bought them at a accretive multiple for what they're going to sell for. So again, it maximized their value going through that process of thinking through 5 years ago, why isn't our business worth more, and what are things we can do to diversify our client concentration and grow the business to show that we can grow the business. And when they demonstrated they could not only grow organically, they could also grow externally through acquisitions, and that their industry was ripe for more acquisitions, it really maximized the value.
Awesome. Anything else we want to highlight on this slide? We do have some questions on the next one, Brian. We have some questions that have come up in the chat. So what else do we want to highlight here?
I think the only thing, and I know we talked about it, but I've got this little saying, the one with companies with poor financial statements. I always say that having good quality financial statements may not increase the value of your company, but having poor financial statements definitely will decrease the value of your company. And that's why preparing your company's financial statements and getting them seller ready are so important.
Okay. A couple of questions. So with regards, of course, you knew these questions were going to come in with regards to the diligence adjustments, because those are real dollar impacts. And like you said, they only impact down, not up. So let's talk about two that we have some questions on: cash to accrual conversion. And then the other one is accounting errors. Any comments on those two?
Well, so we do see a lot of times where a company is run on QuickBooks and they do cash basis accounting or hybrid accrual accounting. In most cases, the buy side diligence is going to come in and they're going to convert everything to GAAP financials. And the other thing is a lot of the seller purchase agreements, the buy side, I mean, again, they're bringing their hired guns and professional service firms to tear your financials apart, and they're using good attorneys, and they put language in your in the purchase agreement that says your financials are in accordance with GAAP. When you talk about these accounting errors as the other item, you usually have to rep that your financials were done accurately or to the best of your knowledge, that you're not aware of any errors or omissions in your financial statements. Those are things that, the buy side is going to come in, and that's how they justify their high fees, is looking for issues that they can find when they go through the diligence process. The other big one on the cash to accrual that's really become a bigger issue recently is revenue recognition. So making sure that your revenue is properly classified in the appropriate periods, and your expenses are matched up properly for that.
Okay, great. That sounds good. I think we are moving. Aren't most GAAP adjustments AR accruals?
Well, there can be lots of different companies that, we've seen companies that don't cost their inventory properly, and it's found out during due diligence. A lot of times it is that revenue recognition isn't properly accounted for. Cash is recorded as revenue when it's received versus having accounts receivable accruals on the books. But prepaid insurance, property taxes, all the things that should be accrued for every month need to all be accounted for properly. And goes back to what I was saying earlier about why working capital is so important, is to have a good working capital analysis. And, you have to take into account those adjustments that you put it into your working capital calculation.
Great. Okay. Thank you, Brian. That's been really good. Oh, here we go. One more. Nope. Here we go. Last one, I think, is our last polling question, right, Deb?
Is indeed.
All righty. Let's get to it.
Last but not least, how many questions have you asked during the presentation so far? And all those people that are putting 0, I expect a question right now, please.
No, this has been great. I mean, not many times do majority of the people stay on for a 3-hour webinar CPE event. So thank you everyone for your patience in dealing with us. But this has been a lot of good insight shared today. So thank you to all of our panelists as well.
Agree. There's a fun, not everybody can see the Q&A, but there's some fun questions. Somebody asked what was for lunch. Somebody asked earlier, they were going to go get a Diet Coke. Did anybody want one? So, we tried to keep this as conversational, and kind of more in-person feeling, at least as we could, given that it's obviously virtual and all our folks are in different locations. So we appreciate the humor and the fun that you guys are trying to bring to it.
Yeah, absolutely. And we will get the recording handouts to everyone as a follow-up. Thank you so much for attending, for sure. Okay, well, let's talk about, this was talking about a simplified playbook. And let's kind of just go over this really quickly. Steve, feel free to reach out to Debbie and we will get you that CPE. Organizational readiness. Let's talk about this real quick, Jeff.
Yeah, it's, we have done assessments and helped companies that were in the SPAC process where we'll go in and assess your finance organization. What do you have, both in terms of positions filled as well as the capability and experiences of the people that are in those roles. It's not intended to identify people to be replaced at all. If you start early enough, it's a chance to identify developmental areas where you can turn a good accountant into an SEC accountant potentially, or develop your controller, or get someone to a different job where maybe they're a better fit. Institutional history is incredibly valuable in these kind of situations. So you generally want to keep your longstanding finance people and just kind of fit them into the right slots.
Great. Okay.
And so just another one, this is an example where we would assess against a predefined set of skill sets and experiences. Like others had said before, somebody's been there, done that. But if they haven't, you can see what experiences they've had, what's their capability of learning to be a public company ready, specifically in this case, and assign a score. But again, this is meant internally. It's not meant as pass fail, but identify, where do you need to strengthen up your organization or bring in additional talent and additional capability to fill any gaps.
Great.
And then I think this is us as well. On the finance side, separate from accounting, having a robust, as many people point out, once if you finish a SPAC or do an IPO, it's just starting. You're on a quarterly process of reporting earnings and doing the SEC reporting, and many give guidance for the next quarter. So being able to forecast your business, having disciplined budgeting and reporting, and strong finance leadership is really a key as you go forward and manage investor relations and manage expectations and tell the story of the company.
For the audit readiness, right? Just be prepared for the lift ahead. It's a key piece in order to be able to be public. Don't underestimate it. Can often be a stumbling block for folks. And so the earlier you start, the easier it will be. It'd be my quick takeaway on that slide.
Yeah, and I think you heard the common theme throughout the webcast on tax is, tax should be a priority. We shouldn't come last. Whether you're a buyer or you're a seller, you're going, to the public market or to the private market, right? The value as a buyer or a seller is always after tax.
Whether you're a public company or a private company, looking to go to the public markets or looking for a sell side transaction, having the right controls in place is important. It gives investors confidence that you have good numbers and that you've got solid processes and people in place to manage the business going forward. On the SOX side, for public company readiness, there are a couple things that we think are essential. Doing the right scoping and planning with risk assessment, a risk-based approach. Stakeholder education. A lot of people in the company may not be accustomed to working at a public company, and they may not be aware of the rigorous audit that faces them, right? Both PCAOB audit readiness and then the future SOX. So we take an approach that tries to educate all our stakeholders and business partners along the way. First, starting with what SOX is and what the requirements are and what to expect in each phase of the work. Then helping them understand how to satisfy the audit requirements, both internal and external. Staying closely aligned with your external auditors is super important. Really need to have their input along the way. No matter how good your service provider is supporting you for readiness, you always have to tailor the approach to the specific point of view and expectations of the audit team that's serving you. And so we try to always engage early with the external auditors, get their feedback along the way, and stay closely aligned with them throughout the process.
Awesome. Okay. Question: what are some of the best tools for managing organizations' financial strategy and forecasting? Does anyone might have any comments on that?
You know, the world still evolves largely around Excel, but there are, more sophisticated tools, adaptive planning, Giraffe, that are, really at a level of sophistication that allows you to engage with stakeholders, where everybody's working in the same system, and takes a little bit of a training, but it makes the information more available to the stakeholders and gets beyond finance. A good budget and forecast involves all the operating and business people inside the organization. So the easier you can make that happen, the more robust the process would be.
Yeah, and don't forget about cash forecasting when you're doing your financial forecasting. I think the pandemic taught a lot of companies a lesson that they better be able to forecast their cash on top of managing their cash.
That's actually a great point, Brian. We try to focus on a 3-statement forecast model: income statement, balance sheet, and cash flow. Comprehensive and integrated set of financial statements in a forecast.
Okay. Well, thank you all. Deb, any comments that you want to have lastly?
Sure. Yes, I know I've said it a few times in the chat. Again, any questions related to CPE, DoorDash gift cards, anything at all, really, please email me. Again, it's debbie.fossum@armanino.lp.com. For those that are good, answer all the questions. CPE certificates will be emailed to you from the firm in 48 hours. But again, please reach out to me. When we send this out, I will make sure that my email is included in the recap, so you've got it. And I will send it once again in the chat, just so that everyone is there. So yes, if you've missed it, my email is there. Please, I love all the emails. Please send them to me. I would like to answer all the CPE, all the DoorDash, all the good things. But most importantly, I want to thank all these guys because they've put up with me and they've put together a great presentation. So thank you very much. I love our firm. I love our people. We've got some of the smartest ones around. And Dean, any closing thoughts from you? But that's all I've got.
I think that if anyone is looking for a transaction, you want to get ahead, or you want to follow any of the insight that we've shared today, please reach out to any of us. We're here to partner with you and give you the best possible outcome. So thank you very much. And we definitely want to see how we can help and be with you on your journey. So with that said, thank you all.
Thanks to you, Debbie.
Thanks, everybody.
Thanks, everyone.